There were events happening in the corporate world which were material. And those events included empirically establishing that we, and to a greater extent, the limited liability company, was using natural assets faster than nature was regenerating them, clearly not a sustainable matter. Also, by 1997, Senator Alan White and me and other people realized that the makeup of the market capitalization of some iconic companies was changing. And as we turned into the 21st century, only about 20% of the makeup of the market cap was reflected as additives in a balance sheet according to financial reporting standards. This led to the drafting of guidelines for the Global Reporting Initiative, and the very name of that institution indicates that it was an initiative to try to give guidance to corporations, essentially, and other organizations on how to report on these incorporeals, intangibles, sustainability, and now called ESG issues. It was IFAC, Gordon Lidstrom and Alan Ball, president and then chief executive, called for a meeting at the United Nations. I was chairman of the United Nations on Governance and Oversight and chairman of the GRI at the time. And we discussed that, in fact, directors were not discharging their duty of accountability, because if they were doing an annual report consisting just of the financial statements, according to IASB or FASB, they were obviously not discharging their duty of accountability because of the makeup of the market cap. And then when they started reporting in two silos, financial and then the impacts of how the company made its product, and the impacts, the outputs, then the impacts when the product went into society, and the impacts it had on the Brundtland's three critical dimensions for sustainable development: the economy, society, and the environment. I said at the time that this was divorced from reality, to report in two silos, because in fact these things are like a symphony. They work together in order to produce this symphony. And so the discussion started about connecting this information or integrating this information. And the debate I remember well, going back to about 2008, Sir Michael Peet of Peet Marwick fame, Jennifer Fries, Paul Druckmann, and others, we argued about whether it's connected reporting or integrated reporting to put together the financial and the so-called non-financial information. And the etymology of the word connection is link. The etymology of the word integration is a system. And I and others argued that what we were looking for was a system of corporate reporting, which would be a stepping stone to what we regarded as an end game, namely a global comprehensive corporate reporting system. This led to the GRI and A4S, the Prince Charles's Trust, getting together and launching the International Integrated Reporting Council at St. James's Palace, which I became the founding chairman. And we had drafted already in South Africa the framework for an integrated report, because I, as chairman of the so-called King Committee on Corporate Governance in South Africa, had by 2016 already, 2009, recommended that we should do integrated reports in South Africa. The Johannesburg Stock Exchange agreed with that, and it became a listing requirement. That blueprint was used by the international body in order to draw the IR framework, which we all know so well, the International Integrated Reporting Framework. And so the start of integrating, connecting the financial and non-financial information was there. But we were still looking at sustainability from inside out, how you make your product and the impacts on the outcomes of that. Meanwhile, there were some seismic events, such as the collapse of Lehman Brothers, which showed there was an impact on the financial position of the company, its balance sheet, on its operating performance, its income statement, its cash flow, and its risk profile, its cost of capital. And it was these events that launched Sustainability Accountancy Standards Board, also approximately 10, 11 years ago. And they started looking at sustainability from the impacts of the Brundtland's 3 critical dimensions for sustainable development. I'll use their language: people, planet, and prosperity, on the limited liability company, and of course other organizations. So suddenly we saw that sustainability, like a coin, had 2 sides to it. And in 2019, I gave a talk in London, and fortunately, the executives of the myriad of framework providers and standard setters that had leapt into this ESG space were present. And I said it was a moral and social outrage that they saw themselves as competitors when they were in fact all had the same end, the same outcome they wanted, namely a global comprehensive corporate reporting system and some consistency in this reporting rather than the clutter and confusion which was being created for preparers and for users. I'm told that this had some effect on the executives of the various entities, but it was really, I believe, the pandemic, COVID pandemic, where they were able to see the power of SDG 17, collaboration. Our scientists collaborated in 9 months to develop a vaccine rather than 9 years. And so the group of 5, which included the IRC and SASB, issued a statement of collaboration. Inevitably, collaboration led to talks of merger, and SASB and the IRC merged. And then further talks, further progress. The VRF was, I'm going to use a commercial term, sold. There was no price, sold to the IFRS. And the SASB standards were pushed into a new body being formed, the International Sustainability Standards Board, also under the oversight of the IFRS, but a sibling to the IASB. And the IR framework would remain in the IFRS. Well, there was a problem with that as we proceeded, because the IASB and the ISSB have power to evolve, to set standards. The IFRS is a monitoring and oversight board under IOSCO, and they don't have the power to create standards. Or so I speculate that I think the answer to the problem is for IFRS to pass ownership jointly to the IASB and the ISSB to form a working group in regard to the IR framework, which would be a baseline for the creation of the integration and connectivity of the financial and the non-financial. Meanwhile, the ISSB would go about its business of forming global baseline sustainability reporting disclosures, which the different jurisdictions in the world on a layered approach could add what was pertinent to them in their area. So I think the beginning of the end of clutter and confusion was the issue of the statement of collaboration. But we're now at the beginning of the end of all that, and we're at a whole new beginning. And we are, I think, through IFRS, about to create a very large stepping stone towards moving from a side of the river of corporate reporting, of clutter and confusion, to one of a global comprehensive corporate reporting system. And hence, in deciding the content and the theme of the 7th colloquium, we use the word connectivity. And it is so important that this is connected. And what intrigues me, and I think it'll intrigue all of us as the years progress, that the one common cause of the EU with its ERSR and the SEC in Europe, China with some of its statements, that the one common cause going through all these international bodies is that there needs to be this connectivity between the financial and the non-financial. Otherwise, you will not get the true enterprise value of a corporation, and hence the theme of connectivity. Thank you, Karen.
Thank you so much, Professor King. Wise words. I'm going to call on, thank you so much. I'm going to call on Veronica now to provide our keynote talk. Thank you, Veronica.
Thank you, Carolyn. And thank you, Mervyn, for this excellent opening remarks. It is a great pleasure to be with you today. And as Mervyn has already indicated, the theme of the day is connectivity. Well, nowadays, the words connectivity and integration are used very regularly in the context of corporate reporting, corporate governance, business strategy, and standard setting. So they definitely deserve a closer look. Let me start with integrated thinking, the subject that I know is very close to Mervyn's heart. Integrated thinking is a powerful concept. It involves integrating considerations of people, planet, and prosperity into the core of the business. Or in other words, taking a holistic view of the factors that can create or erode value. It helps companies understand enterprise value through a lens that balances short and long-term outcomes. The lens that acknowledges that companies rely on a wide range of resources, be it natural, human, social, or financial. This understanding is business critical for companies to be able to create value sustainably over time. And this is because our world has changed. Mervyn talked about how our world has changed. But it is absolutely true to observe that the context in which companies now operate has been transformed by climate change, nature loss, social unrest around inclusion and working conditions, and all exacerbated by the global pandemic and now conflict in Ukraine. The top 10 risks identified in the 2022 World Economic Forum Global Risks Report are nearly all related to environmental, social, and governance issues. And there is a growing realization that these issues can impact a business significantly. They can affect its financial position, performance, and reputation, and ultimately its ability to create enterprise value over time. This impact on financial outcomes is sometimes obvious. So, for example, when a company discharges toxic waste into a river or a tanker spills oil into a sea, and there are direct costs of dealing with that incident, legal costs, penalties, they will all hit companies' P&L. So that link to financial is obvious. In other cases, the link is a bit more subtle. So, for example, poor working conditions and practices may affect attrition rates, rate of absences, ability to attract talent, and this over time will affect operating margins and ultimately the value of the company. And of course, employees are increasingly concerned with the impacts their employers have not only on them, but also on people, planet, and social prosperity more generally. Consumer behaviors are changing too. People are increasingly wanting to purchase products they view as sustainable across the entire value chain, including matters of equity and equality. And they also want to believe that their consumption habits won't negatively affect the environment. Now, technology has played a huge role. The global flow of information and digital platforms have helped raise awareness of ecological and social crises around the world. This digitally enabled transparency has changed societal expectations of how companies should be playing their part in addressing these issues. All of these factors affect the business license to operate, and again, ultimately, a company's enterprise value. The investment community has been very quick to understand that companies with strong sustainability record can deliver superior financial returns. And therefore, they are also looking for data to help them identify companies that are integrating sustainability topics into the core of their business. In other words, companies that apply integrated thinking. Now, embedding integrated thinking often demands organizational change, business model transformation, and a cultural shift. And it often requires a multi-year program to build capacity, codify those new organizational KPIs to measure what matters, and foster organizational transparency and accountability. So we can jump to the first slide. This shows the roadmap which we have developed that helps companies to progress on their transparency and accountability journey, which you can see now on screen. It's structured as a number of different circles. And for each element, we have set out a detailed set of considerations and actions to help companies develop their capacity and enhance integrated thinking and reporting. At the center of our roadmap is company's purpose. The company's ability to create long-term enterprise value is directly linked to how the company aligns its purpose and values with the expectations of the society. Now, the purpose of business in many respects is being redefined as enterprises move to embrace what has become known as stakeholder capitalism, acknowledging the importance of delivering value to all stakeholders, including employees, suppliers, communities, natural environment, and of course, shareholders. People and planet are well understood concepts. Prosperity perhaps needs a moment's pause here. Prosperity is connected to economic and social value creation through employment, financial investment, product innovation, tax contributions. The prosperity of society at large is a prerequisite for the success of a company. And that's why we tend to talk about people, planet, and prosperity. Now, stakeholder capitalism is not about politics. It is not woke or some ideological agenda. It is capitalism, driven by mutually beneficial relationships between the company and its stakeholders, its employees, customers, suppliers, communities the company relies on to prosper. So to quote Larry Fink, in today's globally interconnected world, a company must create value for and be valued by its full range of stakeholders in order to be able to deliver long-term value for its shareholders. Now, companies don't just integrate those considerations into their purpose, they also need to live their purpose. And this means the purpose should drive companies' governance, its strategy, its risk management, and the metrics and targets it sets for itself. In other words, consideration of planet, people, and prosperity should be embedded into a company's governance strategy, risk management, and metrics and targets. Integrated, if you wish. So let's dive into each of these key aspects. We won't go deep, we'll just do a little dive. So governance. Governance is the foundation. No, if we go to the previous slide of the roadmap, please. Thank you. Governance is the foundation for driving performance and delivering long-term success. Integrated thinking requires appropriate oversight and ownership. And so the board needs to make sure that the company's purpose incorporates consideration of people, planet, and prosperity appropriately, that culture and values are aligned to that purpose, and that the appropriate targets are then set across the whole organization. The board will also need to oversee responsibilities, data quality and assurance, the consistency of capital allocation decisions with the company's purpose, and the remuneration policy. There is a lot here for the boards to think about and do, and therefore consideration needs to be given as to whether the board itself has the right skills and competencies to support this integrated approach to corporate governance or integrated governance. The integrated thinking should be reflected in the company's strategy. Now, the strategic approach should take into account the cost, availability, and of course, limits on the use of resources, business transformation, organizational change, and it needs to address potential trade-offs. Integrated approach to risk management requires a cross-functional approach and a broader viewpoint, including issues throughout the value chain and over different time horizons. However, the key here is that a holistic approach to risk management is needed. This ultimately means integration of sustainability risks in the overall enterprise risk management process into the ERM, and it needs to be subject to the same ownership, monitoring, internal controls, and reporting to the board as we have for financial risks. Aligning metrics and targets to the strategy and the commitments made by the company is essential to manage performance. A review of systems, processes, and controls will be needed to incorporate these broader KPIs into management accounting and reporting. Now, a critical part of integrated thinking is reporting in an integrated way, or as Mervyn was talking about, integrated reporting. Reporting that reflects integrated thinking, that is authentic to how the business is run, including shortfalls and continued challenges. This type of reporting can inspire trust and it can enhance enterprise value. There is plenty of evidence to that effect. And stakeholders want to understand an organization's commitments to achieve positive impact, how the company plans to meet these commitments, how the progress is measured. Integrated reporting enables company to communicate all of that in a holistic way. And of course, everything I have described here is very much what Mervyn was talking about. And Mervyn, as the architect of integrated reporting, has been advocating for many years this approach, integrated thinking approach, including integrated reporting as to how that integrated thinking plays out in practice. So I must acknowledge his huge contribution to furthering integrated thinking within a business. So if we could go to the next slide now, please. So integrated thinking is essential not only at an individual company level, but we should be applying it at a broader capital markets and corporate reporting ecosystem level in order to get to the effective, comprehensive corporate reporting that provides transparency, accountability, and delivers most importantly, behavioral change. There are many elements to this ecosystem. Governments around the world develop policy to safeguard the public interest. The public policy needs to be supported by laws and regulations. And a critical step in integrated thinking at the system level, therefore, has to be a greater focus on the responsibilities of company directors. So, for example, in the UK, the directors have a Section 172 duty that is set out in company law to promote the success of the company. Now, in fulfilling this duty, they are required to consider, amongst other things, the impact on stakeholders and the environment. So as they promote the success of the company, stakeholders have to be front of mind. Environment has to be front of mind. This should be embedded in companies' corporate governance systems, and it needs to be supported by reporting on how directors have fulfilled their duties. Now, this sort of clarity around fiduciary duties of directors should lead the boards to consider enhancements to their governance and controls over the broader set of information that supports their reporting on how they discharge these duties. So, and this in turn, of course, should set the right tone from the top, should set the right tone for behavior change that leads companies to embed issues relating to our planet and society into the core of their business. Now, laws and regulations should then also respect the principles of proportionality. The scope of application of the requirements needs to consider the range of companies that contribute to economic growth, from the very small, the smallest SMEs, to the largest public interest entities. To embrace considerations of people, planet, and societal prosperity, we need integrated thinking across different types and different sizes of companies, because more often than not, we will need companies to report on risks and opportunities across their entire value chains. And of course, that is where you get a whole selection of different size and types of players. So we need that integration, that connectivity of thinking as to how we tackle the total corporate reporting ecosystem rather than just focusing on the biggest. Standard setting is a critical element of the capital markets ecosystem. It needs to serve capital markets to deliver consistent, comparable, and reliable information to support capital allocation decisions, to support public policy objectives, where these demand transparency on, say, compliance with specific policies, or they seek transparency on broader impacts of companies on society. And European Green Deal would be one example of where that is now playing out in practice. Of course, standards then need to be applied in practice. And here we need connected thinking in the ways they are brought into laws and regulations, how they are implemented, how they are monitored and enforced. And this includes taking an integrated approach to audit and assurance, and of course, an integrated approach to education and training of finance professionals. But let me come back to standard setting. The need for connectivity when it comes to standard setting is essential if corporate reporting is to deliver meaningful information. Now, connectivity is needed between the standards for financial reporting and sustainability disclosures. It is needed for the standards for enterprise value relevant sustainability disclosure and the standards that deal with broader impacts. And potentially that connectivity is also needed between the standards for private and public sector reporting. Because don't forget, public sector is a huge participant in the capital markets in the world. Critically, we need connected thinking across jurisdictions. Fragmented approach to standards and regulation is very challenging, and it is challenging on many counts. It leads to the lack of comparability. It promotes compliance mentality. It increases complexity and costs for companies, and it ultimately results in information that makes it difficult to see the wood for the trees. And that doesn't help us. It doesn't help us as a society to move forward if we're still confused. So how do we avoid fragmentation? Well, the answer, I believe, actually lies in the way we think about materiality. In other words, how we determine what sustainability information should be disclosed to serve the needs of capital markets and what information could satisfy broader objectives, for example, objectives of multi-stakeholder reporting. So can we jump onto the next slide, please? And let's talk about materiality. Mervyn referenced the group of 5 of leading sustainability standard setters and framework providers. And I was very privileged to facilitate that work. So we got going very early in 2019 and managed to achieve quite a lot, including the ultimate collaboration and consolidation in the marketplace. So the group of 5 of leading sustainability standard setters had set out their thinking about materiality as it is now shown on the slide. This thinking reflects that materiality is nested and dynamic. Now, dynamic materiality recognizes that whilst the company may have many positive and negative impacts on people, planet, and social prosperity, a subset of those impacts can in turn positively or negatively affect the company's business model. And therefore, they can create or erode its enterprise value and financial returns to providers of financial capital. It also captures the fact that over time, sustainability issues evolve. They're not static, and they can evolve very quickly, which we have seen with the play out of the pandemic and now seeing, unfortunately, with the play out of the conflict. Some of these effects on enterprise value are already represented as monetary amounts that we recognize in the financial statements, and the others should be captured through appropriate disclosure requirements. So, looking at this diagram, the big lens covers all sustainability matters that reflect a company's positive or negative contribution to sustainable development, and therefore matters that could inform assessments and decisions made by a wide range of users, including business partners, civil society organizations, consumers, customers, employees, governments, local communities, and all the other stakeholders. Now, the middle lens covers the subset of sustainability matters that influence enterprise value, or in other words, matters that affect companies' ability to generate financial returns over time to providers of financial capital. Now, the small lens also covers a subset of sustainability matters that influence enterprise value, but these matters are already captured in monetary amounts that are accounted for and disclosed in the financial statements. Now, this thinking about materiality shows the way how a comprehensive system of corporate reporting standards can be built, and it underpins the thinking behind what is often referred to as a building blocks approach. So if we can jump onto the next slide, please. Here you see the portrayal, if you wish, of the building blocks approach. So we have made a very significant step in building this comprehensive system by establishing the ISSB to address standards for disclosure of sustainability matters relevant to enterprise value, which should connect to and complement financial reporting, because that is obviously also enterprise value relevant information. This should enable us to put the first foundational, if you wish, block in place. ISSB standards, and there is a big if here, if implemented consistently around the globe, should facilitate consistent and comparable reporting by companies across jurisdictions, which will then help us make informed capital allocation decisions and direct that capital to long-term, resilient, and sustainable enterprise. Further blocks that are designed to meet specific public policy priorities at jurisdiction level or perhaps that could enable reporting on impacts relevant to broader stakeholders, can be introduced as a top-up, or in other words, as additional blocks. So if we jump onto the next slide, please. So one of the key reasons why the ISSB is uniquely positioned to address the needs of capital markets and deliver us that infrastructure critical block for the information that is focused on enterprise value and serves the needs of investors and the needs of global capital markets, it's because of the structured connectivity that is achieved by putting it under the umbrella of the IFRS Foundation. Connectivity between the information that companies disclose about sustainability matters that they view as material to their ability to create and sustain value over time should be connected to the information in the financial statements that ultimately should show how their governance strategy, risk management activities of these sustainability matters affect the actual financial performance. So in other words, how does that excellent narrative, those metrics, translate into what is the actual financial performance in a period? How does it affect the balances of assets and liabilities that had been recognized? And of course, that trickles through many judgments in the financial statements. It should trickle through many judgments in the financial statements if those sustainability matters are appropriately integrated into the company's strategy, into the KPIs, into what is monitored, measured, and reported. Well, hence, ISB and ISSB will need to work together in order to evolve common concepts and reporting principles that facilitate that sort of connected reporting. The ISSB exposure draft on general disclosure requirements that was published very recently, and hopefully you're all planning to comment on it. I think the comment period closes at the end of July, so you have got plenty of time to look at it and comment. But that exposure draft on general disclosure requirements provides us with a very good insight on how connectivity can be achieved. It already uses key concepts that are consistent with financial reporting standards. So including things like, what is the reporting channel? What's the reporting frequency? Definition of materiality, definition of reporting boundary, what's in, what's out ultimately, and consistent attributes of information. So what am I looking for when I report the information? And of course, I'm always looking for that, relevance and verifiability and materiality as the core attributes. Now, ISB and ISSB will need to develop a conceptual framework that will support connected standard setting and can identify objectives, common concepts that are needed for that connected standard setting process. They will also need to develop something similar to an integrated reporting framework. And Mervyn talked about this. This is really important. This can be an evolution of the existing IR framework and management commentary work that the IASB has already been doing, but it should be designed to guide preparers in their reporting in an integrated way, in a connected way. But connectivity in standard settings should also lead to connected thinking about specific accounting issues. So take, for example, intangibles. Many intangible assets do not readily meet definition of assets in the financial reporting conceptual framework because of the inability to demonstrate control. So workforce would be, a classic example of that. And so they do not get to be recognized on the company's balance sheets. Yet understanding what they are, what those intangibles are, how they're managed, how they're enhanced and maintained, is quite fundamental to understanding the value of the business today. And again, Mervyn already has mentioned the critical statistic here. As we know, more than 90% of an enterprise value these days can be represented by those intangibles. So we do need to get to a deeper understanding. Now, another example is accounting and disclosure in respect of climate change. Now, the ISSB exposure draft on climate disclosure proposes a range of disclosures about the impact of climate change on the financial statements balances, on the profit and loss account, on the balance sheet, on the cash flow statement. But in my view, now would be a good opportunity for the IASB, for the accounting standard setter, financial reporting standard setter, to consider whether their standards are fit for purpose in order to serve an enhanced disclosure objective in respect of climate change. And they should probably look as to whether enhancements are needed in respect of the IFRS requirements, for example, in terms of disclosure of estimation uncertainty that we currently do in a limited way in the notes to the financial statements. Ultimately, it is important that the right conditions are created to achieve connectivity in standard setting between IASB and ISSB, including the day-to-day working of the two boards and their staff. Because it's only when we do this, we will end up with the key elements of information that we need to enable that proper information flow into the capital markets, information that displays all the key pieces, the narrative context, the metrics and the numbers, and provides a connected and comprehensive information set. But let's jump onto the next slide. I have talked quite a bit on the importance of connected thinking in the way the standards are set for the first building block, for disclosures that is relevant to the capital markets. But we need to be more ambitious, and we need to start thinking as to how we can achieve greater connectivity and interoperability with other elements that support the broader public reporting ecosystem. So I wanted to share with you a possible blueprint for the future. It is based on the work of the Accountancy Europe task force that I chaired in respect of interconnected standard setting. We had published that report in 2019 with further updates to it in 2020. And this comprehensive vision needs to incorporate the wider lens of reporting on broader impacts, such as impacts on broader stakeholders and sustainable development, including impacts on our planet's ecosystems like oceans, like sea life, where establishing a direct link to a specific company activities isn't actually possible. Now, GRI has a very strong history of operating in that space, and it would make a lot of sense, certainly in my view, to build on that valuable knowledge and build on that experience when putting in place a standard setting mechanism that can achieve that essential interoperability with the ISSB standards. So in that regard, I very much welcome the announcement of collaboration between GRI and the ISSB. I also welcome the formation by the ISSB of a working group to include jurisdictional initiatives on sustainability reporting. Now, that step should definitely facilitate creation of the global baseline of sustainability disclosure relevant to enterprise value. But it's not just the fact that we are trying to create interoperability in order to align with what we report. We also need to think as to how that reporting evolves over time and what the standards will need to capture tomorrow. So this collaboration should inform the ISSB about the issues that are becoming the focus of public policy, for example, issues that might become enterprise value relevant in view of the dynamic nature of sustainability matters. So what that will allow, it will allow the system to be agile, responsive to the issues of the day. And in the world of sustainability, that is absolutely critical. As I already mentioned, we could be even more ambitious. We could go further in the future by evolving the IFRS Foundation to become a new corporate or even public reporting foundation. And we could extend its umbrella to cover reporting on broader impacts and to broader stakeholders, and even think about the public sector and its reporting, both on financial and sustainability matters, and whether it should be under the same umbrella. Well, I've talked for quite a while now, and as you will have gathered from my remarks, I'm a great believer in integrated thinking at both individual company level and at the corporate reporting ecosystem level. connected thinking. Connected thinking moves us forward. It moves us forward at a greater pace, which is exactly what we need to do in order to make progress in sustainable development, progress in achieving the sustainable development goals, and to give us a fighting chance against the risk of climate change. So thank you for listening to me for such a long time.
Thank you so much, Veronica. That was really very, very useful information and deep insights. We've got lots of questions in the chats. I see, yes, access to presentations. Yes, we will have access to the presentations afterwards. We'll be posting that to the event site. To clarify the 3 different measures of materiality, if you could maybe take us back to that comment and provide us some clarity on that, Veronica.
Yeah, so maybe Caroline, you can share the slide again, the materiality one. Would that be possible?
Yes, I'll do that.
So as I was saying earlier on, and I will start talking about it, there are many issues that, ultimately sustainability issues that are relevant that we may want to hear about. We may want to hear about companies' impacts on broader societal stakeholder issues on the macro system, if you wish, level. So if you look at the macro system level, if you look at those issues from the we are all part of the same world, then there is a lot to report. So that is the outer box here, reporting on matters that reflect the organization's significant impacts on the traditional, if you wish, sustainability lens, the outward lens, impacts on economy, environment, and people. But then we do need to think which subset of that is already so material to my ability to create sustainably value over time. And that is the middle box. Can you see that captures the reporting on a subset of sustainability topics that are material for me to be able to create enterprise value consistently over time? So take climate, for example. I think any of the entities' impacts on climate now are enterprise value relevant because climate is just so immediate now. It is here, it is now. Take something like biodiversity. So for someone like Deloitte, for example, it is a bit less obvious how that link plays out, how it is directly enterprise value relevant today. But for a pharma company or a company in the agriculture business, that is already enterprise value relevant today. It's essential. So I think this is the dynamism we are talking about. As these issues become more immediate, more direct, they enter that middle box. I don't capture all of them in the financial statements. So that middle box is about sustainability disclosure, and that is the box where ISSB will operate. So what my supposition then is that GRI, who is an expert on the outer box, should continue to play in the outer box. They should continue to do a lot of advanced thinking. They should collaborate and work with many others, but they should continue to benefit us all through their experience of standard setting, tackling those issues. ISSB will focus on the middle box. The ISB will focus on the little box, that is financial statements, and working together, creating an interoperable system so that when I report about the matter, which is the same, I use the same metrics, the same disclosure requirements. That's when we get to consistent, comprehensive reporting.
Thank you, Veronica. I've got a couple more questions and then we need to move on to Alan Johnson's talk, but I'm going to the Q&A now. And there's a comment here from Sean in terms of the enterprise value trinity is represented by value creation, value preservation, and value destruction. These 3 forces are dynamic, so sustainable value equals the 3 added together. Question: how can sustainability reporting standards hope to best capture and communicate this information? the value creation information.
So, and I think this is where it goes to the right metrics. Ultimately, yes, you can put a lot of narrative around it, but fundamentally, it's the right metrics. What is driving specific values? What is creating specific risks? You know, take accident rate in mining, occurrences of child labor in my supply chain, for example. These are all the metrics that will directly tell me how I can erode value, or vice versa, how I can be sustaining or enhancing my value by having a robust, reliable supply chain, by reducing the occurrence of the accidents rates in mining, for example. And that is quite important to understand, because that health and safety record is either a cost or a benefit to me, depends on which way you want. And so if it is a cost, it obviously erodes my value. If it is a benefit, it obviously enhances my value. And of course, in certain cases, without it, I can't even preserve my value. If I can't get my health and safety record straight, I may lose my license to operate. Have to do it.
Thank you, Victoria. Thank you, Veronica. I've got a question here from Victoria. I'm hoping that Victoria will come on live in a minute to ask us. There she is. If she can just ask us a question around the need for TCFD. Hi, Victoria. You're on mute. There we go.
Hi, Carolyn, and hi, Veronica. I have a rather more controversial question next, but I won't say that one. You can read that one separately. Thank you for your contribution. My question is, I'm increasingly seeing that we have a need for a TGFD. So we have the TCFD, and of course it has a role for governance in there. It's relatively light touch, and having spent 5 years with Carolyn, bringing about ISO 37000 as the first global consensus on the sort of integrated governance we need, we have the platform to say, actually, maybe we need to lean very heavily into governance now and say, you know, starting perhaps with the task force on governance related financial disclosures, so that rather than just governance being a light touch part of all the TNFD and everything that comes later, we really lean into that. So I wondered if you and Professor King had a view on that.
Thank you, Victoria.
I'll jump in very quickly, and then Mervyn, I would love to hear your perspective. But in my view, I think it is absolutely clear we do not have as much understanding and as much guidance, as much framework thinking around reporting on both S and G. So both S and G need investing in. So governance is one of those absolutely critical things that without it, you just cannot create integrated thinking within an organization. And without integrated thinking, I think we go nowhere. So to me, therefore, I think focusing on that, how do you integrate consideration of sustainability issues into the governance of specific matters is absolutely critical. And that is why when I started my talk, I started with integrated approach to governance, because I think that is absolutely critical. And I noticed you were talking about TGFD or TNFD. I think they are great efforts. And I think now that we have put appropriate mechanisms in the ecosystem to try and focus on the, if you wish, focus standard setting effort, those efforts by the various task forces, like TNFD is a great example, should be collaborating with the global standard setter, with the ISSB, effectively doing the research phase of any project in that specific space. They should be helping us accelerating some of that thinking. So TNFD, as I say, is a great example of where this is happening in practice. And with a bit of luck, what we are going to see is that all that great work that TNFD is doing now is going to inform and be passed on to the ISSB to take it into the actual standard. And ditto we need to do with governance.
Thank you, Veronica. I know that you're not here for the Q&A, which is why we're allowing questions now. Just a last one, Anna-Marie van der Merwe, I see you are online. If you could just ask your question, please. Thanks.
Let me just make sure you can hear me.
Yes, Yes, we can now.
It would
Thanks.
help if I can operate the technology. Veronica, thank you for your insightful presentation. Just listening to you again and the comments being made, you know, the plea that I have, and I wanted to just hear you, is the concern that things are going to become overcomplicated again, and that we're going to go down the route where non-financial reporting standards are going to become as complicated as the financial reporting standards. I'm already seeing companies putting out integrated annual reports and sustainability reports, and you know, it becomes a nightmare to try and find your way through the reporting. So, you know, I sort of wanted to ask, how do we help it to be not overcomplicated, to keep it simple to the extent possible, so that it's really insightful, value-adding, useful information? So that was just my comment and observation. Thank you.
And Anne-Marie, you're not alone in your comment. I think it is exactly what you hear as a scream from many stakeholders, from companies, from investors, from everyone. And it is very much about the need to harmonize and streamline, because the complexity arises when we try to articulate the same thing in too many different ways. The complexity arises currently when we have got the transitional period, if you wish, when we are moving from an alphabet soup of various frameworks, voluntary reporting, ad hoc reporting, you know, on a data which is of, in many cases, of dubious quality, if I were to be frank. And then we're moving into a much more mainstream reporting, subject to the governance and controls and subject to requirements of the disclosure standards. Now, if we have the one disclosure standard, the definitive disclosure standard, then we cut out a huge amount of complexity. And I hear your point about the financial reporting standards are complex, but the reality is, and I have been in the world of IFRS since its inception. You know, I'm the IFRS leader for the Deloitte network, and I have worked on implementing the challenging IFRS accounting at many different clients. And what I think you see is that it's not the accounting per se that is complex. Our world is complex. And the reality is, particularly when it comes to debits and credits, it's very difficult to try and create artificial simplicity. When issues are different, when they're not comparable, you need to be able to reflect them appropriately. And that's why we are where we are with the accounting standards. They are getting more complex, and so is our world. Now, on sustainability, if we can get to alignment, if we can stick with the principle-based standards, then I think we have a really good chance to get to simplified, clear disclosures that serves the needs of stakeholders, not just shareholders. I think that's really important. And I would very strongly encourage you to look at the exposure drafts, because actually, when you look at the exposure draft on general requirements or on climate, you will find it builds, climate in particular, builds on CCFD, is actually quite straightforward, gives you the guidance in the appendices on the methodologies, on the measurement methodologies, but it is overarching approach there is it is principles based. So I think that is our best chance. And I think if you do have comments on where this is going beyond the principles, becoming too prescriptive and would hinder good, high quality information flow, that's exactly what you need to comment on to the ISSB to deal with that.
Thank you so much, Veronica, and thank you so much for joining us today. We really are very grateful to have you give our keynote speech to today's colloquium. Thank you.
Thank you.
I'm going to move on to Mr. Johnson now. Alan Johnson is president of the International Federation of Accountants, and he's going to be talking to us about the role of integrated reporting in reviving the economy. And Alan, you were talking, Veronica was just talking about simplicity and standardization and stakeholder transparency. So this is really interesting to hear your perspectives and using integrated reporting to revive the economy on that perspective. Thank you.
Thank you very much, Caroline. Good afternoon, good evening, probably, and good morning to all of you. It's a real pleasure to join you today. May I also really thank Mervyn and Caroline for inviting me to speak, and congratulations to the Good Governance Academy on this 7th Colloquium on Connectivity. I'll just begin maybe with a few words about IFAC for those that don't know who we are. So we are the global voice of the accounting profession. We represent more than 3 million professional accountants through our 180 member organizations across about 135 countries. And our mission is simply to serve the public interest by enhancing the relevance, the reputation, and the value of the accountancy profession around the world. And essentially our work falls into 3 areas. We represent an advocate for the profession as its global voice. We support and promote the development, adoption, and implementation of high-quality international standards, and you've just been talking about international standards. And we help equip the profession for the future through our member organizations and all the individuals that our member organizations represent around the world. In many ways, the Good Governance Academy and IFAC share many things in common. The GGA, I'll use that abbreviation for the Good Governance Academy, is about sharing information on critical issues in areas of governance, integrated reporting, and other issues such as public good. Everything we do at IFAC is about ensuring our global profession serves the public interest, supports equitable and sustainable economic development, thus leading, hopefully, to a fairer society. And this colloquium is a forum for many of the most pressing issues on our profession's agenda today. So without further ado, let me turn to some of those. So the topic today, my topic is the role of integrated reporting in reviving the global economy. For centuries, accounting has been the language of business, of governments, of trade, and indeed of capital markets. But in the 21st century, it has become clear that this language is insufficient in a rapidly changing world. Even the fundamental concepts such as what is value and how is value created or how should it be created are not always accounted for in the traditional financial methods of reporting on an organization's activities and impacts. And this has been made very clear by Mervyn for many, many, many years. So integrated reporting brings together all relevant narrative, quantified and monetized information related to value creation. And the integrated reporting processes, in our view, they have 3 key features. First, it incorporates the same level of quality expected from financial reporting. And I believe that is important. Second, it is a predictive as well as a historical analysis of performance and resilience. And third, it can enable integrated management thinking, which is what is ultimately needed to improve decision-making and capital allocation. And I know that Veronica was talking about integrated thinking and integrated reporting earlier. You know, organizations are increasingly using integrated thinking and reporting to connect all the important aspects of value creation and sustainability right across the business. They're using integrated reports to get the best, the most complete information to investors and stakeholders, and to engage with them about the full scope of the company's activities. And importantly, as I've seen, the role of business is its role in society. The essential context for this is the trend, is the current age of disruption. Digitalization is changing entire industries and many processes that employ countless numbers of individuals. Financial markets are fraught with geopolitical and economic volatility. We've seen it in the past 2 years, and sadly, even more recent than that, and vulnerable to disruption by externalities. Some we can predict, many we cannot. The deepening climate emergency and the ongoing COVID-19 crisis have shown us that institutions can be affected, social lives can be affected, and the economy is fragile. So since the International Integrated Reporting Council was formed with the support of IFAC in 2010, I think, the number of organizations using integrated reports has grown, with now more than 2,500 organizations in over 70 countries implementing integrated reporting. When IFAC supported the creation of the IIRC in 2010, we aimed to enhance corporate reporting in a way that would enable boards of directors to discharge a duty of accountability well beyond financial performance. For us as the accounting profession, integrated reporting was a significant milestone. As I've already said, financial accounting and reporting have long been the language of business and capital markets. They are, of course, critical and remain so, but on their own, they are no longer sufficient for boards to discharge their duty of accountability for long-term value creation and their duty in terms of their responsibility to govern organizations properly. And it was interesting, I think it was Victoria who raised the issue of governance. We now need to respond to the demands from investors, from policymakers, and all stakeholders for a reporting system that delivers consistent, comparable, reliable, and assurable information related to enterprise value creation and sustainable development. Because the price of continuing with a fragmented approach is inefficiency, increased costs and complexity. I had a question on complexity to investors and to companies, but also a lack of trust. And we all know the importance of trust. We know how long it takes time to establish and build trust, but we also know that that can be lost extremely quickly. And we've seen many examples of that in recent years. So IFAC has worked very hard through 2020 and 2021 to support the establishment of the new International Sustainability Standards Board under the IFRS Foundation. And we enthusiastically welcome the news of its formation. Climate and other sustainability issues are global in nature, and the IWSB should and will deliver a global solution for sustainability disclosures. The multi-jurisdictional footprint of the IWSB reflects this reality and can hopefully facilitate implementation of the IWSB standards. Because achieving the full promise of the IWSB certainly will be a much longer effort. It will take a lot of work, but for now, we encourage all stakeholders in value creation to remain engaged at the jurisdiction level and to speak strongly in support of the IWSB's two initial pronouncements, which are open for public comment. I think Veronica mentioned that, and I think the comment period is through to the late July. We also welcome the decision last year to combine the Climate Disclosure Standards Board, so the CDSB, and the Value Reporting Foundation, the VRF, with the IFRS Foundation, providing much needed consolidation and contributing support and resources towards the success of the IWSB. Again, trying to ensure we avoid fragmentation, build on a solid base that has been developed over many years by different standard setting boards, but bringing all the, I think Veronica used the word alphabet soup, bringing that all together so we actually can see clearly where to go, the direction, and how to get there. We believe that this consolidation will position the IWSB to build upon the high quality work of existing sustainability related initiatives, and importantly, to harmonize the standard setting landscape. Ultimately, this system will deliver a comprehensive global baseline of sustainability information that is material to enterprise value, connected to financial reporting through the fundamental concepts and guiding principles of integrated reporting. And these organizations under the IFRS Foundation are the bedrock for the next crucial phase of international standard setting on sustainability reporting. And as a result, they are crucial for effective integrated thinking and reporting. It is worth asking, I guess, where does integrated reporting fit into the real world? And let me try to provide a few thoughts on this. In any discussion, it is important we do not forget where we are trying to go as a profession, as partners in the pursuit of economic recovery. We want to support, we want to deliver, and we want to act on a full understanding of value and value creation in each of our organizations. Corporate reporting is not only about greater transparency and accountability for performance. In my view, it is also equally important that it is meant to convey how a company creates and sustains value and ensures that this information truly reflects the business operations and the impacts on society, impacts on the environment. Because this information gets to the heart of public interest. Everyone, not only companies, shareholders, but also its managers, employees, the customers, the regulators, civil society, and other observers. Everyone needs the most complete picture of value and value creation that an organization can offer. And this is a precondition, in my view, for achieving a sustainable economic and environmental future. So to better position investors and asset managers to allocate capital toward long-term value creation, there's a strong need not only to move to global standard setting for non-financial reporting under the IWSB, but at the same time to embrace integrated reporting principles. The development, the adoption and implementation of the IWSB standards will enhance the quality of reporting and support robust assurance processes. However, in connected corporate reporting that has integrated thinking at its heart is the foundation for changing corporate behavior and corporate practices. The International Integrated Reporting Framework provides the strategic context and a framework for global efforts to develop standards and ensures alignment between internal thinking and external reporting. Reporting needs to reflect how companies really operate. Because if companies are reporting on information on what matters that they are not managing, you have to ask why not. And equally, we have to ask the question, if companies are not managing significant matters on which they're not reporting, why not? So those companies, in my view, that benefit the most from an integrated approach usually have their chief financial officers, and senior officers and finance teams as a central part of this effort. Because CFOs and finance leaders are in an ideal position to help shift the corporate mindset from short-term shareholder value creation to long-term stakeholder value creation and stakeholder protection. I believe that through integrated reporting, they can better deliver these insights to boards, to CEOs, to managers, investors, and others. And in terms of reporting, CFOs can connect non-financial areas to core strategic objectives and the financial decisions that are made. They can also ensure that all external and internal reporting is consistent in content and consistent in messaging. And integrated reporting provides a foundation for rethinking value creation because it empowers organizations to break down reporting silos and recast reporting as a more meaningful activity involving the measurement, the management, and the communication of what matters to long-term success, while of course, not forgetting that we have to deliver short-term resilience and short-term performance. I believe we are at an exciting moment in the evolution of corporate disclosures, but it is through the integration of these disclosures, not just the proliferation of disclosures themselves, that investors and other stakeholders can properly assess a company's exposure to sustainability risks, its ability to manage those risks, and its actual performance on sustainability and other issues. So for our work towards sustainability to have real value, it must lead to different behaviors. Reporting, yes, is essential, but even the best and most useful disclosures are no more than information. Whether a company's behaviors change is a truer measure of its progress in aligning short-term decision toward long-term value creation, sustainability, and resilience. Any company can claim to be building sustainability information into, for example, its strategic decision-making. But the bar is much higher than that. Companies must also practice, choose, and act differently. And professional accountants are well positioned to objectively identify and analyze these strategic trade-offs that need to be made. And it is important because sustainability and multi-stakeholder agenda often presents these trade-offs, and the judgment call is needed about how they can be reconciled with business objectives. For example, there are obvious potential conflicts between long-term sustainability objectives and short-term profitability or misalignment between competing stakeholder interests. CFOs and finance functions need to understand how best to address these challenges in planning and execution. But so do investors. Investors need to support organizations they invest in to focus on longer-term sustainable strategies and not just concentrate on the next quarter's or the next half year's financial statements. And we can only say so much about the future because the specific details will depend on the countless choices yet to be made and the many externalities. Some, as I said earlier, we can predict, some we can see, and many that we cannot. But our profession can and should make informed decisions that build resilience into foundational systems and institutions. We need to collaborate and stay agile as a profession and as individual professionals amid all of this uncertainty and fast change. So to conclude, I'd like to emphasize the role of our profession, wherever we practice our skills, to help achieve a fundamental reorientation of society towards sustainability and fairness. Because our jobs as civil servants, as servants of the public interest, is to ensure that our profession helps create a better world for all people. Our role relates to the resilience of society as a whole through sustainable value creation, through trust and fairness in institutions, a healthy natural environment, and economic revival. Because not only is there an incredibly important need for the profession to lead on sustainability, to fulfill this public interest mandate, but there's also an incredible opportunity, and in fact, a desire for us to help those in private and public sectors make the tough choices that are inevitably facing every country as a result of the pandemic and other issues that we face today. But let us take this opportunity to do what is right for the long-term benefit of all. The profession can create a better, more resilient world with stronger economies and fairer societies by doing so. Developing, adopting, and implementing global standards for sustainability disclosures remains critical. It remains critical for our profession, and it remains critical that we continue to support the IWSB. It should be a top priority for the global profession with the urgency of the climate emergency itself. Now I'd like to sort of turn to Mervyn and thank him, because he's the main reason why for the past 10 years or so we've been talking about integrated reporting. He's clearly the renowned international corporate governance expert and sustainability pioneer, challenging businesses to change the way they address corporate strategy and corporate governance, forcing us all to think and plan on a longer-term horizon and ensure that organizations' purpose goes well beyond the interests of just a few stakeholders. The creation of the IIRC was his initiative, and it has driven so much of the change in both corporate decision-making, but also corporate reporting. He has challenged our profession to step up, to understand our role in creating, protecting, and reporting value, and of course, to ensure there's effective governance at the heart of every organization, be it a public organization or a private organization, be it for profit or not for profit. The governance of these organizations needs to be at the highest possible level. Mervyn, your leadership has resulted in improvements to the quality of information, a more cohesive and efficient approach to corporate reporting, enhancements to accountability and stewardship, and driven integrated thinking, decision-making and actions that focus on the creation of value over the short, the medium, and the long term. So Mervyn, on behalf of IFAC and the entire accountancy profession, I'd like to thank you again for your contributions over many decades to making the world more fair and more sustainable. And I would also like to congratulate the Good Governance Academy on the colloquia that you've had for 6 years and the 7th this year. It really is a privilege to have been the IFAC president, especially in these very challenging times. It is a time, as I've said, of many challenges, but also many, many opportunities. So thank you all for what you are doing, playing your part to making this world a better place that we can be proud of and we can hand over to our kids in a better place than the one that we found it in. Thank you very much.
Thank you very much, Alan. Mervyn, would you like to respond?
Yes, thank you very much, Alan, for those comments. You're correct. I have spent a couple of decades driving the question of integrated thinking and integrated reporting. And I believe we've come to the end of that beginning of clutter and confusion, fragmentation. And we're now at the beginning of the end of something that's a great stepping stone to, I think, an end game of a global comprehensive corporate reporting system, which, if we get the global baselines correct in sustainability reporting, and each jurisdiction can add or subtract things which are pertinent to that jurisdiction, I think we would have achieved a lot. It would be a huge stepping stone to that end game. And I want to personally thank you, Alan, for the contribution you've made to the profession during your presidency. Thank you very much, and thank you for your comments about me. Thank you.
Thank you very much, both of you. And I'd like to now take a break. We've got a 5-minute break, and then thereafter, I'm just going to show you the ESG Exchange video again. And just to say that Alan is a proud member of our governing council of the ESG Exchange, and we'll have more about the ESG Exchange at a later stage when we announce more members on our governing council, which includes, of course, Veronica Poole as well. So if we take a 5-minute break now, thank you very much, everyone. And I'll just share the ESG Exchange video. I do have some bad news about Eelco. Eelco is stuck in a train in France, so he will be dialing in. You could see his telephone icon there. He'll be dialing in on the phone, and we'll have him in about 5 to 10 minutes time. So thank you very much, everyone. And we'll chat later. Thanks.
Thank you.
Okay. Do you want a cup of tea? Right?
Company reports will soon need to include both financial and non-financial sustainability information. but no one knows how to create sustainable reports that are both assurable and provide necessary information. In fact, no one knows what a good sustainability reporting system should look like. ESG Exchange's unique how-to playbook will change that. It will provide companies with a play-by-play guide to sustainability reporting. The ESG Exchange is a collaborative knowledge exchange. Its sustainability reporting development program is based on a 5-module playbook and is prepared for 5 key corporate roles: sustainable data collection and management capabilities, processes, analysis, reporting and assurance, and continual improvement capabilities. The playbook is created through global collaboration with leading standard setters and professional bodies. The ESG Exchange is an initiative of the Good Governance Academy with Mervyn as founder and patron. Its founding sponsor is Archer, a leading provider of enterprise risk management solutions. ESG Exchange represents diverse professions, economic sectors and regions. It is intended and positioned for corporate leaders and operational managers. The ESG Exchange is available globally with events hosted as online webinars, multimedia content, forums, learning management, and other online material are accessible via a secure online portal. All live events will be available in 3 time zones. The ESG Exchange will hold its first plenary in September 2022.
It's a vision I had in living in aeroplanes and going around the world to universities and business schools, lecturing, talking to international institutions like IFAC, people at IOSCO and IFRS, etc. That the teaching of business science issues, for example, ESG issues, were different at different institutions, and the understanding of it was different at different institutions. And the thought was to educate the educators, to make sure that we had a bunch of new executives coming out that were really conscious corporate leaders. The end game is to have a global comprehensive corporate reporting system.
So thanks, everyone. I do see that we've got some questions and comments about the ESG Exchange. I know, Estelle, just to answer your question, what is the ESG Exchange? It really is a global knowledge base. And together with this knowledge base or knowledge exchange of curated content, so essentially not the noise and clutter that you see when you Google ESG or you Google sustainability reporting. It is a repository of curated content, so content that's actually been looked through by those in the know who know what good content looks like. But together with this knowledge base is also a how-to playbook. And this how-to playbook allows or takes organizations through to sustainability reporting, especially in terms of the standards that are coming through now from the ISSB that Veronica spoke about, as well as the US's SEC and the EU's, the TCFDs, etc., that are coming from EFRAG. So looking at all the global sustainability reporting standards that are coming out today, it is very difficult for organizations to understand where to start. And if they have already produced these sustainability reports, how to pivot to these new sustainability standards. So the content and the program that has been developed, this how-to playbook, has really being developed through a collaboration of the standard setters themselves, as well as regulators such as IOSCO, the regulator for the stock exchanges, as Professor King mentioned in the video, as well as other professional bodies such as the AICPA and IFAC. And the collaboration with these large global bodies means that we will get comparability, or at least a parity around the information that is being taught and that the reports that are being produced or published. And of course, the end game is this corporate reporting system of corporate reporting that brings through accountability for sustainable development. And for the organization themselves, they will be able to publish at the end of the how-to playbook comparable and assurable sustainability reports meeting those requirements of those standard setters as well as the regulators involved. So both for the environment, the economy, having accountability for sustainable development, as well as the organization being able to have comparable, assurable sustainability reports. And then for the individual, for us, it's important for us to receive international certification of our and recognition of our foundational understanding of these factors, of the various different terminologies, and this the materiality example that Veronica gave of all the different terminologies. So it's important even as individuals for us to be able to demonstrate our international understanding, our foundational understanding, and our through an international certification. So that is all included in the ESG Exchange. And as the video said, Estelle, this will be published and launched in our first plenary in September. And prior to that, we will have some launch events. And one of our launch events is a partnership event with our founding sponsor, and that's Archer. And you heard a little bit about Archer in the presentation. We do have Peter Duffy on the line. So during the Q&A and panel discussion, if there are any more questions around this, Peter is actually chair of our technical committee as well. Peter will be able to answer some of those questions. But now, since we've got Eelco online and we have managed to get him to talk to us. Oh no, is he still online? I see his telephone has disappeared, so maybe he's not available. And I wonder if Suresh, if you are available, and I see that you're online, and it's a good follow on from what Alan was saying in terms of the integrated reporting. Suresh or Yusha, if you could give us your case studies around your various organizations. I see that Suresh, yes. Thank you very much. And you have somebody to present your slides for you, do you?
I think I will have to do it myself. It's all right, don't worry.
All right.
Actually, what I have is a prepared text, so I can manage. That's okay. Shall I try to present my screen in that case?
Yes, you're welcome to, or I can share them for you if you would like that.
Okay, if you don't mind.
Yes.
Caroline.
I'll open them up now.
Yeah. There is a little bit of animation. I hope. Oh,
I've just got the PDF, so not sure if there's animation there.
It's all right. No, it need not work. That's great. That's okay. That's fine. Okay, let me start. Can I?
Yes, please do. Thank you, Suresh.
Thank you. So good day to you, ladies and gentlemen. Thank you, Professor Mervyn King, Caroline, and the Good Governance Academy for inviting me to speak at this prestigious forum. I really appreciate it, and I feel honored about this invitation. The topic assigned to me today is integrated reporting and the anatomy of a corporate. So as a corporate executive, I will try to give my views on the direction of corporates, on the direction that corporates might take towards integrated thinking and connectivity. We all know that the human anatomy is extremely complex and sophisticated. As for me and some others, this marvel is the work of the creator, and for the rest, it is a creation of nature or samsara, as spoken in this part of the world. Let us now look at the anatomy of a corporate. A corporate entity is a very complex collection of systems featuring resources, forces, drivers, interdependent dependencies, links, dynamics, interactions, cultures, and many more facets, operating in an environment where change is a norm. Whilst human anatomy is well designed and requires interventions only when external interferences such as diseases occur, an organization requires management interventions at design stage and continuously during its lifespan. In fact, everything about a corporate is human-made. So knowledge about an organization is key to integrated reporting. In order to create and nurture a corporate anatomy, if I may say so, we need loads of knowledge about it and its workings. We need to know as to how the resources, forces, drivers, interdependencies, etc., interact with each other and with external factors in the short, medium, and long term. That being so, we know that knowledge created through research on corporate anatomy stands well behind the research about the human anatomy. In order to improve visibility and connectivity within the organization, we need to create knowledge through research and seek technology interventions to elicit more information about the interplays, trade-off impacts, and sensitivities within the organization. Then, as I see, there is a dual role that integrated reporting plays in an organization. One internally and the other externally. Internally, integrated reporting promotes efficient use of resources, whilst externally, it helps to communicate with stakeholders more objectively and more transparently. It also helps to synchronize and combine internal reporting with external reporting. So let us ask the question, what can we do now as corporates to improve integrated reporting? I think the first step has already been taken 11 years ago, and we have walked a fair distance and are looking far ahead. Again, thank you to Professor Mervyn King. It's your initiative that has got all this going. Integrated reporting has brought forward concepts such as value, capitals, integrated thinking, connectivity to the forefront. So far, the thinking behind IR has helped us to explore the anatomy of our own corporates. What more can we do? Advancements in IR has already improved transparency and quality of what is communicated to stakeholders. Efforts in institutionalization of integrated thinking could further this whilst helping better resource utilization at the same time. Therefore, getting integrated thinking further ingrained in the decision-making process with consistency and uniformity could be the next area for improvement. So what do I mean when I refer to institutionalizing integrated thinking? Let me list a few key aspects to convey what I mean, so that it will provide some clarity to what I'm trying to say. I have noted down about 5 aspects. First, decision-making at lowest possible level should always take into account the short, medium, and long-term impacts of decisions. For example, before we spend money on marketing, we could assess the benefits with maximum possible approximation, of course, of the impacts of it. So say, for example, one of the steps that could be taken is to install a sales and operations system. I think some of us know it as SNOP. That will give us a view of effectiveness of marketing expenses in the short and the near medium term. So the second point I have noted is, the second aspect, establish trade-off thinking company-wide, make it mandatory to assess the value created or diminished. Do this and do this through automated mechanisms wherever possible. For example, pay for performance could consider value creation via all forms of capital. And when you look at when I say all forms of capital, there may be some level of automation or analytics required to support it. Third aspect is have an evaluation mechanism for all previous decisions made. Otherwise, we will not know which direction we are going in with regard to our decisions. Then the fourth I have noted is seek technological interventions to make decision-making or evaluations practical and user-friendly. For example, if an employee is to be trained in customer service, a simulation could be done with the use of technology and business analytics to determine the benefits that the training can bring over a period of time, not only in the short term. So, however, and I can, maybe if I sit for a long time, I can list down many more. But there is one important thing. Most importantly, we should choose to do this only for what is material, because if we try to go this extent for things that are not material, then our costs will outweigh our benefits. So materiality test is very important when we try to institutionalize integrated thinking. Therefore, integrated thinking is about the understanding and management of the total corporate anatomy and the behavior of its systems and resources. Tough though, it is imperative that we take this step for more efficient management of capitals. Perhaps out-of-the-box thinking might be necessary. So I have just looked at a scenario. I looked at a company and tried to document the extent to which some elements related to integrated thinking is institutionalized. That's right. This is the slide that I have for it. So this table tries to show the level of institutionalization by way of colors of different aspects of integrated thinking in respect of each capital. So horizontally, you will see different types of capital. Of course, manufactured capital I have divided into two. Then vertically, you see various aspects of integrated thinking, how it works in an organization. So what you see in green, if you look at the legend, it's institutionalized and intensely managed. So what's in blue is not managed at all. So that's how I try to jot it down. Ideally, all the boxes relating to material matters should be green. So should this organization seek to institutionalize integrated thinking more intensely? Yes. If the chosen answer is yes, the following will be key prerequisites. First is the materiality test, whether it is worthwhile doing this. Then, of course, we have to look at the board of directors, because everything starts there. So the commitment of the board of directors to the belief that, first, value creation in the medium and long term depends on the quality and quantity of required capitals that will be available in the future, and not only on financial and manufactured capital, because this is something that the board is often pressurized or the board focuses on. Then the second belief is that it is necessary to intensely manage all capitals, because if the board doesn't believe this, it's there is no purpose of us trying to institutionalize integrated thinking. And the next belief that I would expect is, in order to manage all relevant capitals, institutionalized management frameworks should be available for all capitals with targets, KPIs, and milestones to be achieved in respect of each capital. So if you look at a couple of more prerequisites, the appetite for the board to review performance of each capital at board meetings and other senior executive management forums is necessary. Otherwise, the junior management will be preparing loads of reports, and it may not reach even the risk management function sometimes. Then another prerequisite is an appetite to seek technological advancements to manage aspects that were listed in the table, such as trade-offs, because without technological interventions, it's very difficult to simulate the short, medium, and long term. So that's a very important thing. But sorry. That being so, we see sometimes there is some reluctance in organizations to institutionalize it. We could understand that institutionalizing integrated thinking in full measure is a gigantic task. We could see it from the table that we saw earlier. That is the table that we have in front of us now. Also, sometimes we see a reluctance on the part of the senior management to attempt this. As I see, there are three main reasons for lack of motivation for organizations to institutionalize integrated thinking. Firstly, is the complexity involved in articulating the corporate anatomy on a piece of paper. It's not an easy thing. Secondly, it is usually because it is the management of financial capital that dominates boardrooms. This used to be the experience of most of us, but we see that slowly changing. Thirdly, the tendency for management, particularly the middle management, to focus on short-term deliverables. But many of us would agree that this has to change and that the boards need to keep to map out a way forward. Let us look at a few examples of how we can start institutionalizing it. I think we need to first think of the measures and evaluations that we have to look at, what is material, and then look at connectivity as a next step. Because if we try to do both these at the same time, it's going to be a little difficult. Can we have a look at the next slide, next table, Caroline? Yes, thank you. As you see in the table, a few examples of aspects that could be evaluated and monitored are identified. These are just examples though. If you like, we can call it the hexagon of capitals. In fact, in our company, we do that. Of course, I don't think I will be infringing any patent because I remember HSBC used this word for one of their products, but this we use internally. The purpose is to monitor and review our capitals in order to get a view of trade-offs and current and future availability of capitals, efficiency at which they are used, and to later establish a mechanism that will support trade-off decisions. Due to its complexity, connectivity can be, if you like, we can take the connectivity aspect later in a phase 2 because it's not easy to do both these. You may feel that we currently do most of these things. That is also true. But what is important is the objectivity of measuring and evaluating this. If we are doing it for the sake of doing it, I don't think we achieve the purpose. So do we do it purposefully? That is the question that we need to ask. Let us look at the usefulness of this. Let us look at a small example. A company allocates a budget to train a customer service executive. In deciding the trade-off for investment, it will be appropriate to look at the impact of that training. If the training is successful, the expectation is, this is a micro level example, of course. If the training is successful, the expectation is that in the short term, the customer satisfaction index, revenues, and the quality of our human capital improves. If the customer service is consistently maintained, it will positively impact the brand equity and provide the company with expansion and investment opportunities. This is a very micro example. This is to illustrate, how far it can be taken in practice. Such thinking will even help to design the training program for the customer service executive. Although this is an example at micro level, in practice, it has to be, again, subject to materiality testing because costs could outweigh benefits. So there is an element of moral responsibility in institutionalizing integrated thinking. This is how I see it. Because expending of capitals create a chain of outcomes and impacts. in a world where resources or capitals are limited, we have a moral responsibility towards using resources at our disposal objectively. So that means without only thinking about the short term. To do this, we need to have a full view of outcomes in the short, medium, and long term, triggered by our expending of resources. Therefore, making best use of resources is a moral obligation of the decision makers. So, are we ready to take the plunge? Shouldn't we have the full visibility of the impact of our trade-off decisions? Should we not look at the short, medium, and long-term impacts of our decisions? Isn't it our moral obligation to evaluate and ensure best use of capitals at our disposal? And finally, will my competitor be doing this? I will leave you with these questions. Thank you very much.
Thank you so much, Suresh. I really appreciate your going through that information. I think as the Diesel and Motor Engineering Company, PLC, just saying that it's truly Sri Lankan owned conglomerate, which was started in 1939. So a true example of sustainability, and especially very important given that the troubles that Sri Lanka is going through at the moment. And Suresh led his organization to win the Integrated Reporting Award ceremony in Sri Lanka. So congratulations, Suresh. It was really important information for us to hear today. Thank you.
Thank you very much, Caroline. Thank you.
Eelco, are you able to talk to us and talk us through the GRI side of things? Are you available now? You are still on mute. I'm just going to check. Otherwise, we can move on to another award winner, and that other award winner is Konica Minolta, a Japanese award winner also in integrated reporting to get lessons learned. So I wonder, Yasu, if you could talk to us, Yasu, about.
Hello.
There we go. All right. Hi, Eelco. You're on live.
Hello. Am I on? Okay, sorry. If you know the film Planes, Trains, and Automobiles, I'm playing the role of Steve Martin today. I have now my 3rd hour delay in a train due to a power cut in France. So if somehow it may be a bit noisy, my apologies for that. And there's no internet, but this works. So I hope you all can hear me. Well, first of all, thank you very much for the occasion to be able to present GRI and our vision on the future of corporate reporting, both financial as impact reporting. And let me try to explain myself and our position a bit, whereby I would like to stress that I think things are not as complicated as they may look. When it comes to when it comes to questions like, where should we start? The landscape is very fragmented. And what should we do? And what will future developments be? I will come to that in a couple of minutes. First of all, who are we? Who is GRI? Basically, we exist now for 25 years. It's our jubileum, and Mervyn is one of our great ex-chairs, very much contributed to our existence. And basically what GRI does is we enable society to have a discussion on impacts based on facts and not on perceptions. And we do so by providing state-of-the-art standards that went through a very rigorous due process. And these standards are as the objective to report on impacts businesses have on environment and socio-economic cohesion. And we do that for the public good, so they are free. And what we've seen in our 25-year history is that the uptake and interest of large businesses to express themselves in these fields and show their commitment to society has been growing exponentially. Over the last years, we saw an increase of the users of our standards to nearly 11,000. And the amount is growing. The amount of downloads of our standards last year amounted to 783,183. And since sustainability and ESG is also about the S and the G, and sometimes we tend to forget, and we look mostly at the E because we understand climate and carbon and can express ourselves perhaps a bit more easy and it's easier monetizable, carbon rights can be traded, then social issues like human rights, diversity, equal pay, indigenous people, social inclusion, and so forth. But the S and the G are, of course, also of the utmost importance. And why do we know that public interest in those topics is growing? 60% of the 783 downloads of our standards around the globe were all on social topics, not on environment, on social. So this 25-year history, where did it bring us and where will it lead us to? First of all, GRI is a big sponsor of the idea that there should be global conversion and a global baseline when it comes to sustainability reporting. We should not complicate things and we should not fragmentate things more. But how fragmented is the current sustainability reporting landscape? On the one hand, if we currently look at it, we have the ISSB, recently incorporated, and its chair, Emmanuel Faber, doing a wonderful job in marketing the ideas and pushing the purpose of the ISSB forward. And the ISSB, of course, incorporating the Value Reporting Foundation, which is IRSC, SASB, and CDSB. So we already see there a consolidation. So there, what we have left is the ISSB with its focus on enterprise value creation and its lens more on investors. On the other hand, we have an initiative by the European Financial Reporting Advisory Group, EFRAG. And they have a mandate to basically execute upon the Corporate Social Reporting Directive that they need to come to, and another abbreviation, European Sustainability Reporting Standards. Let's just call that EFRAG. And EFRAG's mandate is a bit broader. It's not only about the financial part, but also about the impacts part. And I will not go into technical details on double materiality, but that's the standards they are currently developing. What is interested in the EFRAG and the CSRD mandate is that it is about mandatory reporting. In the EU, as planned, they will make it or not is the second thing. In the EU, sustainability reporting will be mandatory as from financial year 2023. What's also quite interesting is that European boards should be accompanied by limited assurance of an external auditor. There's a complication in that I will mention shortly. And what's the threshold? The threshold is quite low. If you meet two of the following three criteria, you fall within the scope of the CSRD, which is 40 million euros revenue, 20 million balance sheet total, or 250 FTEs. Meet two of those criteria, and you have to report on them. So that is quite a low threshold if you compare it with some other thresholds and standards. The interesting part on the limited assurance bid is that in the European Parliament, now there's a whole debate on whether or not the financial accountant of an organization should also be able to provide assurance on sustainability reports. And it looks that most of the European Parliament members think no. How they will manage that from an administrative point of view and an operational point of view, to me, that's a miracle. Because the 50 to 55,000 European companies that fall within the scope need then to find an auditor, not only in the already quite, and here you hear my train stuff, but not only because it is quite, it's not only because it's quite difficult already with the rotations we see in Europe to find an independent auditor, but if you within this already, let's call it restricted environment, you also need to make a choice between financial and sustainability, then it becomes very complicated. Taking into account 55,000 companies that fall within the scope. Where does this leave GRI? Well, we had a co-creation agreement with the EFRAG in order to assist them in the development of their standards. That doesn't mean that GRI standards one-on-one have been adopted by EFRAG in their first drafts. No, not at all. There are big differences between them, and how that will develop, we don't know in the future, because there's some issues now with their governance and the appointment of a new chair and a new technical chair. But the idea, the basic ideas on the thinking of the framework is aligned with GRI standards. On the other hand, we have, of course, ISSB, and as you may have seen, we concluded a Memorandum of Understanding a couple of weeks ago with the ISSB, where we basically drive, and that's our vision, and that it will be our objective and our goal, where we drive towards a so-called two-pillar structure. And what does that mean? It means that we think that both financial reporting and impact reporting are of equal importance, and that they're basically two sides of the same coin. But that is very important for society, for business, for investors, to have a clear landscape with a clear baseline on how to report on a global scale. Because only then we will have comparability. We can manage cost of compliance, and we can see to it that there will be no fragmented regulatory initiatives at country level that will add no value to the objectives we have, which is basically creating a better, healthier, and happier planet for us all. So what does this mean, this Memorandum of Understanding? Well, it basically means that we will converge agendas, look to find how we can align definitions and how we can cooperate in future standard setting on some topics. And perhaps some of you may have seen that last Monday or Tuesday, we set the first step in really operationalizing this cooperation between the two of us. So we foresee an international corporate reporting environment whereby we have financial value creating part and the impacts part on two pillars, supported basically or being put together by proper governance. Is that then a dream? Will it be happening? Well, of course, there is always politics involved. if you would ask me what would be the best way forward, also looking at this European initiative and where that will go to, well, I think it's not that complicated. If you look at the 25-year history of GRI, to which Mervyn contributed a lot, and you look at the history of the IFRS Foundation and International Accounting Standards, and you look at the nearly 11,000 multinationals that currently report under both International Accounting Standards as well as GRI on a voluntary basis, then we see that we have a proof of concept, that we have an environment that is already out there for 25 years and it is being used and apparently to satisfaction of many stakeholders. So why would you like, as a regulator, to change that concept? What we know for investors, as well as civil society, whether it is large unions or other interested stakeholders, that the comparability of data and the predictability of publications are of key importance to make decisions or to get perceptions transferred into facts based on proper reporting. And we do not see why you should try to fundamentally change something that has proved in the past to be more or less a winning concept. And especially now that the focus of society as well as capital markets is on how to operationalize and introduce a structure with this global baseline. The attention is there. So now let's hope that regulators and politicians will be smart to use what's already out there and not try to reinvent the wheel. Then, of course, there is the United States, developments in the United States, and how are we involved in there, and what we see happening. And we live in the interesting period where we basically now have 3 public consultations. The SEC's one on climate, the 510 pages, the ISSB ones, and the FREC. I do not believe, we as GRI, impact reporting, I do not believe that in the United States we will see something like mandatory impact reporting for SEC has not that mandate, and they looking at the political situation. I don't think that will change soon. However, what we do know is that large American corporations are interested in impact reporting and do care about it. Not for nothing that there are many, many US multinationals already for years voluntarily using GRI standards. In fact, what not many people know, there are more US multinationals using GRI than they use SASB. So that brings me to the question whether this type of reporting must be mandatory at all cost. We at GRI are neutral in this. Making something legally mandatory does not always mean that you per se will achieve your objectives. But let me give you a practical example of what I mean. Europe will see mandatory reporting, I guess, also based part on GRI influence standards. On the other hand, you will have the voluntarily impact reporting. As we said, already 11,000 companies do. And now you also have a twilight. You have twilight. That's what I also explained yesterday at the FT's Moral Money event in London. Hence my train. A group of two pension funds, UK pension funds, the Manchester pension funds and the Catholic pension funds, they filed a request with the board of Amazon to bring into vote the use of GRI 207 tax, the tax transparency standard. The only one in its kind, by the way, and already widely used by many multinationals. At Amazon, they didn't think it was a very good idea, so they came with a position paper by Gibson Dunn, where they claimed that basically tax is an operational matter, not a strategic matter, so not something to be voted on an AGM. SEC, a response to that one came a defense letter why it should be voted on, and that in this case it was of strategic importance, etc., etc., etc. That letter, that open letter to the SEC, was signed by a group of investors, most of them with no direct interest in Amazon, by the way, but it was the principle. But the consolidated invested capital of the co-signees of that letter amounted to $3.6 trillion. And the SEC ruled, by the way, that this is a topic that should be or could be voted on the general shareholders meeting, Amazon, on the 25th of this month. And whether it will make it or not, frankly, that's up to the shareholders. It's of course not my call. But what I think is far more interesting on this ruling is that apparently, as a group of large investors, you can force certain topics to be voted on the shareholder meeting, which is not, of course, legally obliged, which is also not voluntarily, but it is twilight. It is in between. You cannot ignore as business wishes of such a group of shareholders. So looking at the time, let me conclude and more or less where I started, that perhaps the system is not that difficult as we think it is, at least from also a conceptual point of view. When it comes to the real standard setting, it is not an alphabet soup. So, I'm sitting on someone's place. No, I'm not. Yes. So I go to another chair. Sorry for my improvisation. The issue is, if you look at the future of corporate reporting, we see it, we have the ISSB, which is about outside in, which means what are the effects of environmental and social issues on the value creation and cash flows of the reporting entity. And on the other hand, you have GRI, which is inside out. What are the effects of organization trying to achieve their strategic objectives on environment and socio-economic cohesion? They both go very well together. It has been a proven concept, and I sincerely hope that regulators see it and will endorse this two-pillar vision. Thank you for your attention. Sorry for the noise and stuff around. I'm now in Lille with a 3-hour delay. 1 more hour to go to Brussels, and then I will be hopefully live in the Q&A session. Thank you.
Thank you so much, Eelco, and for your physical challenges in South Africa. We understand about the power challenges. We're well versed with it. So thank you very much, Eelco, for under the challenging circumstances still being able to provide us with your perspectives. I know that you're not going to be able to stay on for our Q&A later on today, but maybe Mervyn, if I could ask you, perhaps you wanted to have a comment while I ask everybody else if they wanted to just ask any questions they have of Eelco while we have him on the line. Thank you. I'm sorry, Mervyn, you're just muted.
No problem. No problem. Happy to answer them.
Thank you, Eelco. Just asking Mervyn. There we go. Thank you.
As Chair Emeritus of the GRI, I'm proud of the GRI is still going from strength to strength. I mean, everybody saw the EVC as something different from the GRI, in other words, outside in, inside out, but they actually belong to the same coin, as I said. And we get the collaboration, which has now been signed between the ISSB and GRI. Well, that's just going to make the global baseline sustainability disclosure factors much more important in achieving an end game of a global comprehensive corporate reporting system. So I agree with what Eelco said, that the GRI is well known around the world, that it's developed unique standards, absolutely unique, from an independent standards board, and it must continue with its good work.
Thank you so much, Mervyn. Are there any questions? I think we've got one question here for Eelco around from Janice. Excellent. Janice is saying, thanks. Excellent example regarding the pension fund activism and ESG and sustainable development. Are you able to provide any further information on that? And she's actually asking for a link, but I can provide the link later. Is there any further comments you want to make, Eelco, on that pension fund activism?
Yes, I think I can. And we can provide all the information on this case. And there's also another one, a semi-flunked IPO of a platform company, of a platform business, whereby large institutional investors did not subscribe because they said, listen, a business which main business case is based on not withholding taxes, social insurance premiums, pension premiums, and sickness and health insurances, because the business concept is based on working not with employees but with contractors that are deemed independent, cannot be sustainable for various reasons. You will see a mutiny under people working for you, and it will be, or could be also deemed by some jurisdictions as unfair competition. And they were right not to invest in this London IPO, because indeed many courts already ruled that there is in fact a relationship that is more like an employer-employee than independent contractor principle, with terrible financial consequences for those businesses, because retroactive over 5 years, they have to calculate and pay the arrears of withholding income taxes, social insurance premium, pension premiums, etc., etc. It goes into hundreds of millions. But besides that, you can also ask yourself as a business, if you think this social topic not taken into account by building your strategy, where it will lead you to moving into the future, while it's already very difficult to find qualified people. What we know for a fact is that yesterday at that Financial Times session, we saw that again from some very large UK businesses, that their HR officers, they are being questioned on a daily basis by people applying for jobs, what the social footprint of the organization is, how they look at human rights, how they look at equal pay and diversity. Things that in the not too long past, I think that people cared less on than right now. So I can also provide you with, I will send you some information on discussions in and around boardrooms where these things are being taken more serious. So that's what I mean also with Twilight. And perhaps not to overestimate the legal enforceable reporting standards, because society and markets, and also capital markets, are basically forcing you to think about these topics and how you want to be perceived by society. And let me close with this one. Many large businesses that we get questions from, it is about how they can explain to a multi-stakeholder environment the things they do and invest in order to do good. So, for example, when it comes to investments, again, water pollution, or indeed when it comes to human rights, education, safe workplace, etc., it is destroying value for investors and shareholders and your brand name if you do not make it very clear what the investments are and the initiatives you are making in these fields. So not reporting on them is a shame. And we know also that reporting on them when something is not true will backfire greatly. That's the greenwashing, the mining company that was completely GRI compliant. But when a dam broke and it appeared that the water was toxic and there were no safe workplaces, they are now being challenged with the blessings of the SEC by investors that said, we invested in your organization because you had a great social footprint. That's what we got out of your sustainability report. And now it's appeared that it was talk, but not real. So we want to get compensation. So you see the maturity of these reports is increasing fast. 20 years ago, when international accounting standards were introduced and we had the Enden case and the introduction of Sandbox, everyone was saying, well, how are we going to manage financial risk management? It's difficult and cost of compliance. We hear exactly the same discussions on this badly called non-financial, but impact reporting. How do we manage it? How do we measure it? How do we audit it? We don't know, it's all new. But we know financial risk management, Sandbox, I mean, it is within the genes of doing business. And with this, it will be the same. Thank you.
Thank you, Eelco. Yes, I think the mandate and the pressure to move towards disclosing this information and having some depth to it, as you say, some at least making it assurable, is becoming increasingly important. And I think that was one of the questions that we had in our Q&A, is around, is there a demand? There might be a supply, but is there a demand? And you've just articulated a very good example about the demand that is there. And of course, financial penalties don't always help as to compensate for the damage done. I've got another question here from Enrique. Enrique is from Argentina, and I know that he was involved actually in bringing the GRI to Argentina. So it's very nice that he is online. And he's asked a question. Does the GRI have a tentative timeline regarding the execution of the first outcome of the agreement with the IFRS? So in terms of the MOU, or the Memorandum of Understanding with the IFRS and the ISSB, is there a first step or milestone, and what is the date of that milestone? Thanks, Eelco.
The answer is yes. We will have a joint press release shortly. My standards division and the technical boys and girls of the ISSB, we had our kickoff Monday. So I haven't seen, because I also have no internet, what the status is. But yes, shortly we will come out with a timeline and an agenda.
Thank you, Eelco. And thank you very much for joining us today under these such difficult circumstances. It really has been quite brilliant for us to hear you, and I'm sure it's been quite a challenge on your side. So thank you very much for joining us. We really do appreciate it. Now we are
Thank you very much for having me.
Thank you, Eelco. And now we're going to go on to Yasu. Yasu is from Konica Minolta, and he led his organization to some integrated reporting awards and excellence in Japan, which we know is a highly competitive environment for integrated reporting. It's one of the countries with the best integrated reports in the world. So Yasu, if I can ask you to take over from here. Thank you.
Thank you for your introduction. So can you hear me? Yes?
Yes, all good. Thank you.
Yeah, thank you. Thank you for your great introduction. At first, thank you for inviting me to this important event, Professor King and Caroline. It is a great honor to be given this opportunity to share my experiences about integrated reporting. I'm Yasu Kawasugi, working as a head of investor relations at Konica Minolta, a Tokyo-based Japanese listed company, about $9 billion revenue with 40,000 employees globally. Let me jumping into the given topic, a practical benefit of integrated reporting. Slightly maybe different taste from the previous presentations. We transformed our annual report to the integrated report since year 2015, including part of sustainability report and the corporate governance report, etc. And we are utilizing this report as the most important communication tool with stakeholders, especially investors. And recognizing its building process is also important as a meaning of integrated reporting. As known, Japanese companies are the most fan of integrated report. I think there are some context and acknowledge of benefits in behind. I'd like to talk about such context and benefits based on my experiences. 3 key points for today: uniqueness, D&I, diversity, equity, and and the stakeholder. Talking about uniqueness, as you see now, IRC and SASB are integrated as VRF, and ISB is established to integrate VRF further under IFRS. In Japan, we have to file a security report, so-called UHO. It's like a 10K report in the US. During this global standardization trend, Financial Service Agency, or FSA of Japan, in charge of UHO, is trying to improve contents of UHO by including non-financial information by benchmarking integrated report. Means UHO is trying to absorb contents of integrated report. Since I'm participating in the roundtables hosted by FSA about this improvement of UHO for the last 3 years, I have been starting to think about differentiation or repositioning of UHO and integrated report going forward. Integrating non-financial information and financial information was one of the differentiators to such regulatory financial report, but now it's getting closer. UFO is standardized and audited report. Comprehensiveness is required. It's like a compulsory program, and the information should be provided in the same order in terms of the topics. Flexibility is limited in this case. On the other hand, integrated report is like a free program to express yourself by your storyline while utilizing such standards, SASB, IRC, GRI, and TCFD, but more focusing on the individual company's materiality. This difference is very important to highlight company's own unique value creation story. As the integrated report is freer format while referring the common guidelines or frameworks and disclosing standardized metrics for investors to compare the companies. Companies can express their corporate culture or character by designs, colors, pictures, and visuals, etc., to support their own value creation story, which is limited in case of UHO. Issuing timing also matters. UHO is issued in June, while the integrated report is issued in August as an average of Japanese issuing companies. This time lag is important to add additional value on the report by diving deep into the topic and having a plan to highlight company's specific emphasis. Non-financial information, especially intangible assets, such as human assets, technologies, and customer assets, in our case, are important as driver for business growth. We are trying to put voices in the integrated report from our customers, employees, alliance partners, etc., on top of voices from the board, CEO, CFO, and head of business lines to support our value expression and showing the power of the people. Important thing here is that we can consider integrated report as a differentiator to the other companies. It is still challenging to describe clear linkage between such non-financial information and financial information in a quantitative way. However, we are trying to develop our own logic to develop such clear relation between non-financial and financial information. Through this process of building integrated report, there are a lot of strategic discussions to review and align our activities into our story. This is important as the integrated report is working as a media for such discussion to develop company's unique strategy and story. In other words, the integrated report is bringing management and employees on the same boat. Second one is diversity, equity, and inclusion. We need to weave a unique story involving people from different functions, business units, positions, ages, genders, and nationalities. This is an important process to onboard diverse people into the common story. It would be possible to show such diversity as indices in the report. However, integrated report can show them in a vivid and visible manner. Through the creation process of integrated report, we have to work and collaborate closely with those different business units, functions, and people. This process itself is very crucial in terms of the cross-functional or cross-business integrated thinking. And as this process itself involves different people who is not specialized in such reporting, there is opportunity to grow people, skills, and also this could be kind of award for the people by introducing their activities in the report. Third one is stakeholder. In our case, as the integrated report is developed from annual report originally, which was kind of English version UFO without filing. From this history, the primary target reader is, of course, investors. Even within investors, especially after stewardship code effective since 2017 in Japan, this report is important for those persons in charge of voting. By the way, towards annual general meeting on 17th June next month, today, CEO of our company and I had 4 meetings with major shareholders, and one of them was the largest asset manager in Asia. He reviewed kindly our integrated report and provided feedback. While he highly rated our integrated report, but gave hints to improve further, which is including suggestion to raise quantitative target for long-term goal related to non-financial information, for example. So the integrated report is actually well used in the engagement with investors. When I ask them, especially head of stewardship or head of ESG or head of responsible investment in the institutional investors, there are a lot of different names and positions, but they prefer to have engagement meeting right after annual issue of integrated report to discuss wider issues. So issue of integrated report is important trigger to have such engagement nowadays in Japan. In addition, recently our integrated report is well read by other stakeholders such as employees, job searching people, customers, and so on. As the integrated report is visual and cared for the readers, compared to UFO, it is a great tool for employees to understand their belonging company. Sometimes we provide our integrated report to especially large enterprise customers for them to understand or assess from whom they are going to purchase products and services, focusing on a sustainability perspective. Job searching people utilize this report to understand fit of corporate purpose, strategy, and culture, treatment of people, for example, to apply or attempt interviews. This wouldn't be by UFO or 10K type of report. We utilize the contents of our integrated report or its developing process to other communication media as well, such as company profile leaflet and the inner communication booklet, for example, by making a kind of light version. I talked about the benefit of integrated report from 3 key points of view so far: uniqueness, D&I, and the stakeholder. The most important point, I think, here is the integrated report is giving the benefit not only from the report itself as an output, but more from its building process of integrated report as input and the utilizing process to have outcome. Therefore, how to plan or project this building process and utilizing process is crucial by involving or using Veronica's word, connecting internal and external stakeholders or people. And the outcome should be again utilized in the next input to improve the discussion and involvement in the building process. This cycle or spiral must be alongside with growing enterprise value. This is the end of my presentation. If you have questions, I'll be here until the end of this event and happy to answer them later. Thank you for your listening.
Thank you so much. Great information, and it is fantastic that you got them to review your integrated report. Wow, that's quite something. So thank you for that, for all the insights that you gave to us. And I see also we have a comment on the chat that Konica Minolta South Africa has been offsetting their carbon footprint with food and trees for 123 years, and they've planted over 50,000 trees together. That's incredible. So Konica Minolta hasn't only got a great impact in Japan with integrated reporting and improvements in that field, but also in actually tangibly having an impact across the world. So thank you so much for your insights on integrated reporting and a great example for everyone across the world. Thank you so much.
Thank you very much.
I'd like to call now on Kris. Kris, are you there? I see your cameras. Yes, great. Thank you so much. So Kris is going to talk. Kris is from IOSCO. One of the things that IOSCO does is the regulating the stock exchanges. But Kris is going to talk to us about IOSCO steps towards the adoption of connection between the financial and non-financial information. As we've heard from the GRI, we've heard a little bit about the ISSB, we've heard about the SEC's 510-page document, and we've also seen on the chats, are just those 3 institutions, the EU, the ISSB, and SEC, actually reinventing the wheels themselves. So it'll be quite interesting now to hear from IOSCO themselves in terms of the connection between financial and non-financial information. Thank you, Kris, over to you.
Thanks, Caroline. I have to say, I think nature feels I'm not doing enough working on sustainable finance because it's given me allergies. So it's clearly taking its revenge on me. So please apologize. I accept my apologies as I'm trying to get through this, but may lose my voice as I'm going through. Having said that, it's a pleasure to be here with you today. I think the importance of an integrated approach has been clear from the start, but today's input from my fellow panelists, we've just heard, yes, for example, certainly serves as a reminder to anyone who may still be in doubt about the need for such an approach. And as I was reflecting upon today's agenda, I was really struck by how far we've come with regards to sustainability reporting, really in such a short period of time. When the task force on climate-related financial disclosures, the TCFD, was created back in 2015, with the aim of developing consistent disclosures, I think it's fair to say that the topic was not particularly high on regulatory agendas. Yet in the same way as financial markets have an essential role to play in the transition towards a more sustainable economic model, so do regulators in ensuring adequate quality in the information available to these investors, including from its source, corporates themselves. And IOSCO, as some of you may know, has been aware of the what I would call historical importance of these challenges and has treated them as a matter of priority for the past few years, really starting from 2018. We have sought to cover the entire waterfront of emerging risks relating to sustainability. Last year, for example, we released a report covering information on sustainability by corporate issuers. We set out recommendations for fund managers as they seek to market ESG products to their investors, but we also delved into the perhaps tricky issue of ESG ratings, encouraging better governance and more transparency by ESG rating providers, at least on the objectives and the methodologies of their rating products. But really considering asset managers or any other market players for that matter, first is a bit futile without adequate sustainability reporting by issuers. This would be like building a roof without the foundation of a house. Why? Simply put, sustainability reporting, like financial reporting, really are the foundation of capital markets and investment decision-making. In the case of sustainability reporting, I would say it is the cornerstone of any successful transition towards a more sustainable economy. And we've heard from others today on how much demand there is for this transition, and of course, how much need there is from a broader global public policy perspective. I'm of course preaching to the converted today when I say that information on sustainability underpins the valuation of financial instruments and allows investors to make better informed decisions in the same way, once again, as financial reporting information does. And it is a belief that I would say has provided IOSCO with the impetus to add our voice to the others calling for action in this area. Now, unlike in other areas of international financial regulation, you mentioned the regulation of exchanges, Caroline, capital market authorities typically have looked to private independent bodies such as the IFRS, IASB, and FASB to develop sound technical standards for corporate reporting, audit, and assurance. And it's that same philosophy that led IOSCO to call for the creation of the International Sustainability Reporting Standards Board within the structure of the IFRS Foundation, with the aim of establishing a global framework that I think everyone would agree is a necessity. So we were pleased when less than a year ago that call for action was heard and the ISSB was set up. We've also been really encouraged by how quickly Emmanuel, Sue, and their teams have stood ready to go from concept to delivery, with exposure drafts being ready in quasi-record time. I don't think I've ever seen anything happen that quickly in public policy making. Now, looking at the exposure draft and eventually the standards themselves, I think will help clear the way for corporates to accelerate progress towards disclosing complete, consistent, and comparable information on sustainability matters. They could really usher in a new area for corporate reporting, setting the foundations for what we see as a comprehensive global corporate reporting system that brings in both financial and sustainability related reporting together. While we've come a long way, the largest leg of the journey remains in front of us. The publication of the exposure drafts is a giant leap in the right direction, that's for sure. But as the international standard setter for securities regulators, we will want to ensure a few objectives are met by the drafts. And I'll go through them at high level and then go into a bit more detail. So we'll want to ensure those standards can serve as an effective global baseline for investor-focused standards, are sufficiently interoperable with other frameworks, and act as a building block for any national or regional jurisdictions who might wish to add to them without losing comparability. And that touches a little bit on the point you've just made, I think, Caroline. And we'll want to make sure they are fit for purpose in helping markets accurately assess both risks and opportunities stemming from sustainability factors. And then finally, we'll want to make sure that they form the basis for the development of robust and sound audit and assurance framework, whether through audit firms or through others who are also engaged in those activities at the moment. So in practice, what does that mean? Well, it means considering aspects such as the completeness, consistency, and comparability of sustainability-related information, ensuring the standards provide a common, comprehensive, and structured global framework for sustainability-linked reporting, and that should be building on existing principles, framework, and standards. It also means clarity about both scope and materiality, i.e. in the case of climate, it should cover both the company's resilience to climate risks and the impact of the company's activity on climate to the extent, of course, that this affects value creation, because we are supporters of an enterprise value approach in this context. And finally, they should ensure a level of consistent narrative on the company's strategy, risk management processes, metrics and targets relating to sustainability issues, and how these impact financial results and enterprise value creation. That really builds upon the work that the TCFD did before. We'd also be looking at those standards to provide guidance on science-based metrics that enable accurate assessments of ESG risks and opportunities. And we would be looking for a common taxonomy and structure. And finally, last but not least, perhaps most importantly, I would say for today's context and discussion, we would want those standards to ensure the framework can be integrated with financial reporting standards. So within IOSCO, we have set up the structures needed to review the draft standards to consider whether they meet the principles and the criteria I have just set out for you. And we're currently in the process of analyzing the exposure drafts in detail. I know the ISSB is also actively engaging with a broad range of stakeholders, as it should, to ensure it gathers a full set of perspectives on the drafts. We see that as important to really ensure uptake of the global baseline, and really build that global baseline for sustainability reporting in a way that has support from those.
Kris, we seem to have lost
IOSCO.
you. There we go. You're back.
Can you hear me? What's the last thing you heard?
No, you about a minute ago. No, a couple of seconds ago. You're back again. We just can't see your picture. That's all.
My computer keeps freezing on me. So if I disappear, I'm really sorry about that. I will connect again.
We can hear you now. Thanks.
Brilliant. Thanks, Caroline. So I don't know at what point the ISSB is actively engaging with a broad range of stakeholders. We think that is the right thing to do on the ISSB side, not only through consultation, but as they have been doing through bilateral engagement, because it is important to ensure uptake, to ensure buy-in into those standards, as that will help build a global baseline for sustainability reporting that everybody hopefully can subscribe to. IOSCO has and will continue to engage with the ISSB. Deepened our collaboration with the IFRS Foundation as the work has progressed. And I would say, once again, this is the beginning of the journey, not the end. But from our perspective, the end goal is clear. We want corporate disclosures that are complete, consistent, and comparable across corporates, sectors, and jurisdictions from a sustainability perspective, in many ways in the same way as is the case for the IFRS standards at the moment. And this brings me perhaps a bit closer to today's main topic for discussion, which is the connection between financial and non-financial information. Why? Because connectivity between the front half and the back half of the financial report is of utmost importance to ensure that consistency that I've spoken about, but also the utility of those standards in this area. I think that's recognized by corporates. There was a PwC report towards the end of last year on management of non-financial information, where 87% of senior executives across 50 countries said they were paying closer attention to non-financial factors and use non-financial information in management decision. Almost all of those surveyed, about 95% of them, said that, and I quote, integrating financial and non-financial information improves insights into the process of creating long-term business value and leads to better management decision. That is only possible if you have connectivity between financial reporting and sustainability reporting. And so as I was thinking about what my key messages should be for the session today, I was taken back to a conversation I had with a friend recently who argued that financial reporting shares little in common with sustainability reporting. His argument was that connecting both would actually detract from the importance of considering impacts, as the aims of both sets of reporting, in his view, should be different. He's surprisingly not alone in thinking this. And I say surprisingly because I was generally taken aback by that kind of remarks. We shouldn't forget that IFRS standards already require companies to consider climate and other ESG risks and to make judgments about providing disclosures on these issues in their financial statements. If you think about the concept of financial materiality upon which the IFRS standards are based, it implies that preparers should focus on information which, if omitted, could influence the decision of investors. Now, admittedly, this does not explicitly refer to climate or other ESG risks. And with the evolution of investor demand, I think it was only a matter of time until specific sustainability reporting was needed. But you can really see the need once again, if you take a step back and think about that materiality concept within the IFRS standards, you see the need for connectivity once more. So respectfully, I disagreed with him, and thankfully, so does IOSCO. Though I have to acknowledge, of course, the challenge that connectivity between sustainability reporting and financial reporting implies, for example, in the areas of commitments or assumptions, where several auditors have come out and said that there could be some difficulties there for preparers and then for auditors as well. But the strong belief in the need for connectivity is one of the reasons we supported housing sustainability reporting under the IFRS Foundation. We felt it would better guide reconciliation between sustainability-related disclosures and financial statements.
Now we have lost Kris. That was unfortunate, but I think Kris was coming to the end of her talk. And if she comes back, that will be fantastic. I see that we do have some questions, but Mardi McBrien has joined us. And I wonder if the panelists could please put their cameras on and turn their sound on, and we can have some questions. Welcome, Mardi. Really nice to have you online. Prof. King, we need to turn your camera on and unmute you as well. Peter, you're online, and I'm trying to, Harry, if you can hear me, if you can join us as well, that would be great. And Prof. King, if you would mind just turning on your camera as well, please.
You've stopped it, Karen.
Yeah, there we go. Sorry. Are you on now? Yes, sorry. Wow, oh, there's Harry. Okay, so what a challenging colloquium we have had. So thank you very much, everyone, for joining us. I think we've got lots of questions, and our first question is actually a combination of two that I'd like to ask, and it's about the question of value. So the one question went around, in fact, it was somebody that was quite instrumental in the Lesotho Corporate Governance Code, which has now been published, and we are expecting hard copies shortly. But he was saying, that Straka was saying, I believe it's time for organizations across the board to embrace a shift from the traditional CFO role, Chief Financial Officer role, to a Chief Value Officer role, with a view to better unlock value creation and reporting. So that's the one question. The other one is actually from Victoria again. She says, and she did mention that she had a more difficult one, but what is this definition of value? You know, so we're saying, you know, to move to a Chief Value Officer, but what is this definition of value? And, you know, off the cuff response is always, well, value is in the eyes of the beholder, of course. But maybe just asking you, Mervyn, since you're involved in all of these discussions, and then moving to Mardi, how would you define value in terms of the creation, etc.?
Right. As many of you online will know, that I started this discussion about 10 years ago, that when we started with sustainability reporting, integrated thinking, integrated reporting, and we moved away from the primacy of the shareholder 15 years ago, whenever it was, and we moved to a value creation process. What were the inputs into, I'm using just the limited liability company as an example. What were the inputs into the company? How did the company use that in its operations to make its product? In other words, how did it make its product? And in making its product, what were the impacts on the three critical dimensions for sustainable development? People, planet, and the economy. And then you have your outputs, which is not only the product, but also waste and other things. Then the product goes out into society, and it has an impact on the three critical dimensions for creating sustainable development. So you have outcomes. And the accountant, worth his or her salt today, does not sit only in a corner room and draft the financial statements according to financial reporting standards, be they IASB or FASB. He is, because of his public interest training, he is the change maker in that C-suite. And he starts getting people to change their mindset from success being increased bottom line, increased dividend, increased share price. That was the three criteria for success, notwithstanding that was being subsidized by society and the environment. So the value creation model started dominating the increasing profits for shareholders. In other words, there was a focus on shareholders right through the 20th century, underscored by Milton Friedman from the 1970s. But we saw, unfortunately, that the outcome of that was that companies were using natural assets faster than nature was regenerating them. And also we saw that the makeup of the market cap of companies had changed completely. That 20 to 30% of them only was represented as additives in a balance sheet according to financial reporting standards. The rest were the incorporeals, intangibles, sustainability, and now called ESG factors. And so the accountant was considering all this. And that's why I wrote the book in 2016 with Chief Value Officer, saying that the description of Chief Financial Officer, if the accountant was actually carrying out his or her job properly, is actually a value officer, more than, because they're looking at this value creation proposition. And then the subtitle, which created a lot of debate, Mardi at the time, accountants can save the planet. But value is a question of, is this company actually adding value to society? And the reason why I've developed that definition is when you go back to the middle of the 19th century, when the limited liability was actually legislated about in creating it, it was created by the representative of people in Massachusetts, in America, in the UK. So it was created by society, for society. And it was created because wealthy people were no longer prepared to give money to unlimited liability organizations. Because when the business failed, they were still liable to creditors and employees. And so Lord Gladstone and others concocted this artificial incapacitated person. And Lord Thurlow in 1844, a clergyman, said, and he was absolutely right, that who are we to make a person? Only Almighty God can do so. And we're making a person that has no heart, no mind, no soul, and no conscience. It's correct. The company is an incapacitated artificial person. And that's why I did a broadcast on the Australian Broadcasting Corporation a couple of years ago about the innocent company. The company is always innocent. When something goes wrong, the wrath of society should turn against its corporate leaders. So the concepts have changed completely. There's a different understanding of the company, the corporate being. And the creation of value is value for society, not only a monetary profit, which is subsidized by society and the environment, which most companies were. Until today, you've got people looking at that, and of course, social media comments on about stop it immediately. So hence, I developed also the concept of integrated thinking and integrated reporting. I was the founder chairman of that, and well, you heard the comments today from people who spoke. So the value, the concept of value, but when you talk of value creation, you've got to remember that there's value preservation, and sometimes in companies there's value destruction, value erosion, because they're making their product in such a manner that actually erode, actually wasting the natural asset. Right, so sorry, no answer to your question.
That's perfect. Thank you so much, Mervyn. Mardi, just looking at your profile and seeing that, you know, your depth of experience in both the financial side and the non-financial side, the sustainability side, and you would have seen this concept of value evolving over time. And just a question from your side. I see that you've now landed yourself in the International Financial Reporting Foundation, IFRS, but you're in a place now which is bringing together both of the worlds that you've been in, and your experience is scarce. I mean, in preparation for the ESG Exchange, we did an analysis across the world, and trying to find people that haven't just changed their LinkedIn profile to ESG, but actually have that depth of understanding is really difficult. So from your perspective, have you seen this shift in terms of the value and organizations being valued beyond just that financial and really embracing that sustainability side of things?
Thank you very much. And we definitely have started to see a change. I think the thing is, it's not fast enough. And as you rightly say, the skills are not quite there yet to allow that acceleration that we really need to see. And I feel like I've been banging that drum for about the last 5 years everywhere I've been going. The shift in, you know, not only do we need a chief value officer, as you say, but we need to be changing the skills from the boards right through the business, through every element, through internal controls, internal audit, external audit, you know, the list goes on. It's every single layer to make this business as usual needs to be slightly, you know, brought into this ESG world and upskilled and then connected and using and adapting existing business systems and processes. So it's a slow burn, but I don't think we have that slow burn time anymore. We need to really accelerate. And with the ISSB standards coming, and I'm sure you've talked about it today, but bringing together the IR framework, but much more broadly, you know, the SASB, CDSB, TCFD, all of that together, you know, these things will be global standards in no time. And we need the skill set to go alongside that, Karen. So I hope in the colloquium today you've worked out how we're going to get it.
Yeah. Thanks, Mardi. Yes, and actually that's a great segue into maybe introducing Harry. Harry Broadman, and I've just put his LinkedIn profile on the chat there for people to get to know him better. Harry is actually our chair of the governing council for our ESG Exchange, and the ESG Exchange is sorry, I'm just having a look at the comment on the chat. Hope I have put the right profiles on there. But the ESG Exchange is exactly that, Mardi, is trying to bring together in a collaborative way all of those there's very few very expensive experts, and in such a way that we all are educated with parity, that we've got the same kind of understanding towards, and the same outlook and the same approach to developing those standards, but to developing the reports that go with those standards. But maybe just to go to Harry. So Harry is chair of our governing council, but he's also a Forbes columnist, and he's got quite a lot to say about that integration across all the different roles in an organization. But Harry, from your perspective, in terms of this integration across the roles.
No, I think it's great, and I love Mardi's answer and Mervyn's sort of rendition of how the corporation has evolved over time and sort of addressing this question of where is the value. And it strikes me from a very pragmatic sort of day-to-day business sense, where does this land within the C-suite or the executive part, and where does it land within the board? And there's been obviously a tremendous growth of the appointments of chief sustainability officers in corporations. And the question that I've been wrestling with is, what is actually their role, and how integrated are they into decision-making and operational and investment decisions within the company? And I think the role has actually not been well defined. It varies across companies. And even where there are, very well-known people who have taken on this role, the question in my mind, having spoken with a lot of executives, is, to be frank, how seriously are they taken in terms of actual decision-making, and how integrated are their responsibilities in investment decisions and hiring decisions and all kinds of things. And so this Forbes column that you mentioned, Carolyn, of mine, I went out on a limb and said, maybe the chief sustainability officer should be seen as the integrator in chief. If we really mean seriously what sustainability ought to be within a corporation, it seems to me that that's not, frankly, way out on a limb, that someone needs to sort of weave together the financial, the non-financial, and do it in such a way that is communicated with all the stakeholders of the company, not just the workers and not just the investors, but the communities and so forth. And by the same token, I think the question arises in my mind is, what's the role of the board in sustainability? And we're beginning to see boards of, particularly of public companies, to some extent, creating sustainability committees. I would argue that that's also not too far out on a limb. And if we're really going to take what we've been talking about seriously, the question is, how are we organized within the C-suite and within the boardrooms? And I don't think enough attention has been paid to this. And I think how they are organized and what roles these people take in decision-making, to me, is a litmus test as to how seriously these organizations are actually taking sustainability. That really is where the rubber meets the road. And I think we have a lot of work to do across the world on this particular question.
Harry, you're correct, because it's been proven in practice. When we formed the IRC, so I'm going back some 12, 13 years ago, and sitting having a cup of tea at Fortnum and Mason in Piccadilly in London, having left St. James's Palace, where Liz Charles blessed us for creating the IRC, we had a discussion. And the discussion was, these were some of the founder members of the IRC. And the discussion was, do you start integrated thinking and hope seamlessly you start to do an integrated report? Or does the board say, we are going to do an integrated report? And everybody then starts putting in and thinking on an integrated basis. And what we found, in reality, what happened was, it has to come from the top. The board has to say, we are doing an integrated report. We're going to do it in clear, concise, and understandable language. We're going to take out the information out of the IASB. Now, didn't happen then, but I'm going to go to today's language. Out of the IASB and the ISSB, and we're going to explain it to the user so they can really understand it.
Yep.
Because, I mean, there have been many surveys done, people have found the financial report to be incomprehensible. And I can tell you the same thing is going to happen to the sustainability report. Mea culpa, as chair of the United Nations on corporate governance and chair of the GRI, we started developing a language, as we do in every business. We develop our own jargon. So ecological overshoot. We speak about it as if everybody knew what we were talking about. And I'm afraid it's also going to be complicated to the average user. And when you think about it, the money in companies listed on the NYSE or wherever it is pension funds. And whose money is it? It's a person's walking in New York City or Washington, where you are, yeah, Harry? Oh, I don't know where you live, Marty. Where do you live, Marty?
Washington.
Right now, I'm just around the corner from Fortnum and Mason, so I'm in central London.
Then I must meet you one day for one of Fortnum and Mason's famous scones. I love their scones. But that was a discussion at Fortnum and Mason. So I'll never forget it, because we watched how over the years the question answered itself. So it's the board, you're absolutely right, Harry, the board's got to show that it is committed to this integrated thinking and this value creation process and pushes it through. You can't get it to go from the bottom up.
And if you like, that's one of the benefits that will drive through the new ISSB standards that's driving through this approach, is that it asks you to outline where at the highest level is these issues being discussed, and you have to do it as part of your reporting, which sort of forces it to be from the top. It also looks into things like location of reportings, connected to the financial report and accounts, again, at the same time as the financial reporting, if it's not. So again, how many boards sign off the, links to financial accounts if they haven't had it? I think more and more we're going to have to see this top down rather than the bottom up approach of maybe some of the last 20 years.
I double click on that. Obviously the reporting is extraordinarily important, but it's actually the operational decisions that are taken, right? We can have great reports. We can collect data and do all the things that we're all, want to do and are doing. But the question is, who's making the decisions about where the firm is investing in a new plant, and how is it being done in a way that comports with actually what they're reporting?
Yeah.
And that's where I find that there is a separation of sort of reality and, in fact, the ambition. And the question is, how can we close that gap in a very day-to-day managerial sense? And as we've just been saying, the rubber meets the road with the board and the C-suite, and who they appoint and how much attention they get, and how involved are they in the actual day-to-day decisions.
And then maybe to move on to, and what information are they basing those decisions on? So I know Peter, and just to introduce Peter, is our chair of our technical committee in the ESG Exchange. I'll play the ESG Exchange video again a little bit later at the end of the colloquium. But Peter, you've got and developed the ESG value stack, because there needs to be a fundamental basis on which we're making these decisions. And at the moment, we seem to be making these decisions on not a lot of very valuable data. Maybe you can just give us your experience in terms of what you're seeing in your discussions around the world, in terms of what people are basing their decisions on, and what investors are seeing.
I sometimes, thanks, Caroline, I sometimes feel like a little bit of a party pooper when talking to very knowledgeable people like those here on this call, this panel, because what I'm finding is it's a bit like the joke, the story of blind men in a room, blind people in a room, and they've all got different parts of the elephant, but collectively they don't know it's an elephant, right? Invariably, when we're talking to people, we find that heads of sustainability can be somebody who was a financial journalist 5 years ago, head of general counsel, marketing, corporate social responsibility, EHS. None of those role types have ever typically driven organizational change. And they're then expected to have a conversation with senior executives. And they're speaking in a jargon that doesn't relate to the senior executives. And you may as well have different people with different languages, different creeds and cultures in the same room trying to make sense of something. So in Ireland, we say that sometimes you got to start at the beginning, middle, and end at the same time. And I was on a call just a few days ago with someone who's going to be involved in the exchange, Thierry Krumpelman of ABN AMRO, arguably one of those handful of people that have real scars from, driving this change, this transformation within an organization over a number of years. And I was talking about I think somebody mentioned earlier around the dubious nature. I think it was Veronica at the top, the sometimes dubious nature of the data that's being provided. And he agreed that, quite frankly, when I receive presentations from people who talk about carbon accounting and connections to systems, you follow down the line, you find you're getting connections to Excel spreadsheets. It's like doing an audit and never connecting with the bank account, the one true record of what's in the bank on a given day. So the reality is that everybody has a different point of view, a different understanding. There is no common language. Yes, the frameworks and the standards are in place, but there's a huge amount of confusion. And so I guess the ESG Exchange is all about creating these how-to playbooks. And to your point, Mardi, we don't have time to wait. So effectively, it's about a collaborative environment, a trust environment, a collaborative environment through the plenaries, the round tables, the ESG labs, where corporates will walk into a room, the different personas will walk into the room and explain what's working for them, what's not working for them, and over time, learning from the practitioners what's actually capable of working and what is not, because time is running out, and we probably have less than a handful of years to begin to make some serious traction to the point where we can begin to trust the disclosures that people are making, because the public disclosures we're seeing at the moment, when you look at their data books, you relate them to your standards and so forth, you're finding there's something missing here when you have that knowing eye and so forth. So trust environment, shared collaborative learning, that effectively is what the exchange will seek to deliver through these various work groups and the production of workbooks and the how-to playbooks and so forth. Hope that's, I did put some cold water on the enthusiasm, but we have to recognize that there's a major organizational challenge there and so forth. We're aware of it.
To be honest, organizations, it's not only time, but where are the resources? We've just gone through a pandemic. Many organizations don't exist anymore as a result of the pandemic. Other organizations are really battling. Now we go into, a conflict scenario in Ukraine. We have issues in Sri Lanka. So there are a lot of issues for organizations across the world. So they don't only need to make those big changes, they also need the resources to do that and to do it in timely manner.
And I would say, by the way, some good news, right? Don't let organized common sense is the key to that lock and so forth. Because when you look at what the standards and the frameworks are looking for, effectively is, all of the information that is required, it's available. It is available in organizations because all of the E, S, and G topics, they really relate to all the non-financial activities undertaken to deliver, an outcome, a bit of performance. So the big and basic practical approaches to identifying where good quality information is, gathering it, making sense of it, and so forth. That's the size of the challenge. It's not insurmountable. People just need to be told, signposting the journey essentially is what we will do in the exchange, and give people confidence that they can do it within their own organizations, given their own whatever resources are available to them.
As simply as possible. Thanks, Peter.
As possible. Keep it simple.
Yes. I see Kris is online again. Kris, are you able to just give us the last sound bites in terms of your priorities from an IOSCO perspective?
I will try if technology allows.
We can hear you.
You can hear me. That's a good start. So I suppose what I wanted to leave the audience with is that if the expectations I was mentioning before are met, and we know the ISSB is doing a lot of work to engage with stakeholders to really, understand what's expected and where changes may need to be made, etc. If the final standards meet our expectations, including with regards to appropriate interconnections, then our board will consider endorsing the ISSB standards, as I was saying, in the same way as it did about 20 years ago with the IFRS standards. Now, back then and over time, it led to about 140 jurisdictions embrace the IFRS standards for financial reporting, and that in turn, I think, honestly helped drive the globalization of financial markets. If you look at where we are with sustainability reporting at the moment, very few jurisdictions have requirements in place. So it will be a step in the right direction, but perhaps more importantly than being a step in the right direction, it will be an important step in the right direction. I was reading a review that Deloitte conducted of 2021 annual reports for FTSE 350 companies. And in setting out their findings, they looked at the 5 Ps that, once again, Veronica mentioned earlier about purpose, people, planet, prosperity, and pandemic. And for both people and planet, the evidence consistently demonstrated that some disclosures are being made on key social and environmental issues, but actually they're partial. They fail to include key information on specific KPIs. They fail to include information on specific business changes or activities. In the same vein, TCFD released a status report in 2021, and there's good news in that report because disclosure of information aligned with the TCFD recommendations has increased by about 9%, which I think is the largest increase in any year so far. But once again, there were significant differences that were found, both in terms of the quantity and the quality of disclosures across the recommended disclosures. In addition, it identified that the TCFD adopters across those, only about 20% disclosed impacts on financial performance, and only about 14% disclosed impacts on financial position, really signaling once again the need to improve connectivity between financial and sustainability reporting, and really signaling once again the importance of the work that the ISSB is doing. So action remains urgent, and we shouldn't rest on our laurels because the ISSB is making progress. That's why IOSCO has committed to finalize its endorsement process shortly after the ISSB finalizes the standards. So we'll really try to work in tandem with the ISSB. And that's also why some regulators have already come out and said they would look to implement the ISSB standards if they prove to be adequate. I suppose the final thing I want to leave the audience with is that beyond our role and that of the regulatory community, the work of institutions like the Good Governance Academy is essential to make a success out of this journey. It's helping entities in the ecosystem, like preparers, like assurers, and others, build their capabilities, and that is needed to really deliver on the promise of connected reporting. So we plan to play our role, but we cannot do it alone. So let's make this happen together, is what I would leave you with.
Thank you, Kris. Excellent words. Just to mention that we are summarizing this colloquium in a memorandum, and that memorandum will be out first 2 days of June when we have input from the various parties. So it will summarize the presentations that we've heard today, as well as this Q&A. And also in that, we'll go a little bit more detail around the ESG Exchange, the initiative that we're launching to bring that parity behind the reports and to assist organizations to transition. And also in that we'll have IFAC involvement in terms of crafting the memorandum specifically for their members and the accountants. So I think that's quite important, Kris, in terms of what you were saying in the regulators and because what Mervyn was saying in terms of the Chief Financial Officer's role as a Chief Value Officer in this reporting context. So thank you very much, Kris, for that. I've got a question on the side, and I know that in the Q&A, we've got lots of questions there, and this has come through on the chat, but it's something that I personally have been, it's been coming at me fast and furiously. Is it, what is an ESG strategy? How does the board know a good ESG strategy from a bad ESG strategy? Does my, from a board perspective, do my executives even know what this ESG is actually all about? So the question comes from Cecilia here, says, surely the strategic development process should address the key ESG factors. Yes, I think one would expect that, and include the organization's business model. Now that's the critical one, right? And that's what the transitioning we were talking about now. The high-level strategy and all strategic objectives reported on an integrated report need to be aligned. However, I personally find this lacking. What are your thoughts? So maybe starting, Mervyn, with you in terms of the strategic objectives aligning with the ESG factors.
Well, I think ever since the SDGs came into existence, boards should have sat down and said, what is our business model? What are the SDGs which are pertinent to our business model and to our strategy? And then make sure that that SDG, clean cities, is built into your business model, and operationally you should carry it out as well. Make sure you implement that as part of your strategy. So to end up as a responsible corporate citizen, I think one has to identify the SDG which is pertinent to the business and incorporate it into the business model. And then, of course, the executives have to try and achieve it. And you achieve it through, we've been talking about integrating the thinking and do an integrated report and blah, blah. But I believe you've got to identify, because people now understand the 17 SDGs. And I think 17 should be one, collaboration, and then I don't know why I put collaboration last, because it's turned out to be the most important one. I think once you identified your SDG and you can actually announce that you are going for SDG, as I did in starting the GGA, just that I knew that around the world the people were teaching business science issues differently. Boards that consulted with me were thinking about business science issues differently, and that I realized that SDG 4, quality education, educating the educators to educate those coming out to be what I called conscious corporate leaders, they actually came out knowing to do the right thing. And do the right thing means being a conscious corporate leader in the sense of making sure that the ESG is embedded into your strategy, which is pertinent to your business. And that's how I would deal with that question.
Thank you, Mervyn. So what I'm hearing is that the sustainability report is not just another kind of compliance requirement, a different juggling of the data. There's actually fundamental business model impacts on this, as you were saying, Mervyn, just trying to understand how the sustainable development, those targets are having to be built and produced through your organization, and first of all, understood where they stand in the organization. I see I've got some energy happening. Who wants to go next? Mardi, do you want to have your say on ESG strategy?
There's lots of other people here that can too, but I think what's most interesting about this, and this is increasingly common, where we were talking earlier, where sustainability might not be connected with business completely with business strategy. And so the silos are being built. And so we're getting that disconnect. These things aren't being sewn together from the top down across all departments and up again. This is where this is appearing in silos. And good examples of that at the moment are where we've got organizations committing to things like net zero, but how does that appear in, net zero doesn't come for free. It doesn't come without a strategy and a good plan. And that needs to be outlined in the reporting and be a consistent sort of thread that has financial implications in the back end. We just had Kris talking about the TCFD reporting and only 20% really getting to the financial impacts in the back. This is where the disconnect's coming in, and we need to connect back up this the different bits of the business so they actually understand the implications of what they're saying and doing around this. And I think that will make a big difference. But Harry, love your thoughts.
No, I quite agree. It's interesting that we've come so far in this discussion over the years about, frankly, a silo of financial and non-financial, and frankly, what that has done to some extent is people say, well, the financial is the really important stuff, but the word, the prefix non-financial also is sort of a pejorative term, which I'm trying to overcome in my conversations. But and to that end, I think sort of what I've been saying and what Mervyn and you, Marty, have been saying, and Peter is, we, at least in the United States and in other countries, the SEC, you have to have a qualified financial expert on your board. And we're now moving, there's now been legislation introduced, and SEC just submitted some formal comments on the proposed rule by the SEC about a qualified cyber expert to be on the board. Now, why is it too far a leap to have a qualified sustainability expert on the board as well as a sustainability committee? And I think that's where we need to move to, so that we really, as we've been discussing, really move this integration in a serious kind of way. And I think until companies make that commitment or are obliged to make those kinds of commitments, we still have a long way to go. And so I think I would say that this is not too far off in the future to expect to have a qualified sustainability expert on the board, and the analog essentially to the chief sustainability officer in the C-suite and the sustainability committee on the board. I think that when we get to that point, I will feel that we've really taken a very significant step.
So while you're on the podium, Harry, here's a question from Damien saying, so what is the view of how boards have changed the makeup of their members over recent times and reflect the new skill sets needed to look at the wider world of ESG impacts of the business?
Yeah, it's a great question. It's a question I spend a lot of time discussing in my advisory work with boards. And the fact of the matter is, at least in the United States, we still have obviously we've created the diversity of boards. The delta in the last 10 years to today has obviously been significant. The question is, what ultimately does diversity mean? And it certainly means gender and race and all those kinds of things. But I think where I'm coming from, it also is a larger lens, and in terms of skill sets and international experience and the like. And it's rare in the United States, to be honest, that you see a truly diversified board along all those different arrays. And I think that is the big challenge. And I'm hoping that in our work in the ESG Exchange, we can begin to sort of promote this conversation more forcefully. But I think as we've been discussing, in this particular panel, we really have to integrate within the company itself and the board itself to take this stuff extraordinarily seriously and put your money where your mouth is.
Harry, on diversity, I think what a lot of companies and institutions are overlooking is intergenerational diversity. The millennial thinks differently from me, and Generation Z thinks differently from the millennial. And what some boards are doing, on my advice, is actually they formed a Generation Z committee.
Yep.
And they enter into a contract of non-disclosure, so an NDA, and it's a good faith contract. If they breach it, well, they joined in the UK. It works very easy because they become a member of the IOD UK. Well, if they breach that contract, they'll never become a director in their lives. They know that's the outcome of it. But when you've got an issue and the board discusses and said, let's just get some input from our Generation Z committee. I'm telling you, it is incredible. I've had light bulb experiences.
Yeah.
Now, that is an alarming thing. To think that diversity, people think of race and gender, and it's not.
Yeah.
Thanks. I want to move on. Well, it's kind of on the same thing, topic of diversity, but I'm looking at diversity of industries and sectors. And I want to ask Peter, because although the question from Caitlin says, do you have an opinion which industry sectors are leading in the field of integrated reporting and value creation? And what is making them stand out from other sectors? I actually want to change the question a little, if I may, Caitlin, and ask Peter, because Peter has done a lot of discussions and interviews with people across the world. Peter, do you find a particular industry or sector that's standing out on sustainability reporting and data in what you've seen? Because you've spoken from east to west.
Well, look, because of the global financial crisis and the impact on the banking and financial services sector, it has had to really tune into the importance of maintaining its social contract, which it lost in most cases, on foot of governmental interventions following the GFC. So clearly in that sector, they're very alert to impending regulations, and the rule of thumb there is starting with board education. So people are being taught the language, they're being taught what questions they need to ask, they're being taught how to interrogate the answers from management. And probably that's the purpose of a board member, really, isn't it? Know questions to ask and know how to interrogate the answers. So that industry sector, because of its mistakes in the past, it is probably and possibly momentarily head and shoulders above the rest. And of course, then the heavy emitters. Well, they know because the pension funds essentially are saying, if you don't have a good ESG story, which might have been an AOB item even 2 years ago, it's now in the first few minutes, first quartile for sure of a briefing, analyst briefing. If you don't have a good ESG story, it sets the tone for the rest of the meeting. So the heavy emitters clearly are for reasons of just survival, necessity, whether or not they believe in climate and the climate challenge. And there's a lot of folk who don't necessarily in certain parts of the world, but just for survival. If they don't have a good ESG story, they're not going to get away with that bond and so forth. And if I kind of then just kind of go back then into, and there's a lot of, we know who the heavy emitters are and so forth, but to an earlier point about the strategy and kind of objectives, strategy formulation is kind of relatively easy. It's the hand-waving stuff and the assumptions, people believe in them and they become articulated and all of a sudden they become kind of fact. Whereas strategy execution is tough. It's very, very messy. And there was a time when strategy, meant kind of long-range planning. I don't think anybody can engage in long-range planning anymore because we're living in a very uncertain world and it's becoming more uncertain. So I think the real acid test is this kind of, the ship, the origin of the word, the etymology of the words, governance and steer and going back to the Hellenic Greek times. But, the board is there to mind this clueless child, this company, and it's the thinking piece. And management really are the people who are trimming the sails on the ship and on the assumption that the ship itself is relatively watertight. They are just doing their best to navigate the heavy seas. And they might have an idea in the context of purpose, where it is they want to get to. But quite often the heavy seas can throw you off and you'll end up on a coastline that you're not very familiar with. So I think that fundamentally sustainability is about the ability to weather those storms And really, 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 it's a dear old friend of mine who's now passed, sadly, who spoke about the threat posed by big egos, not just in boards, but at management levels as well, where people are too perhaps shy about asking, demonstrating their ignorance about something. And so people really need to learn to stand up and to be brave about following the PowerPoint and saying, I've got this tell me, show me, prove it to me rule. And typically at the level of a board presentation, 9, 10 out of 10, it's beautiful stuff. And you ask then, okay, that's the tell me, show me where the information has come from. And there's lots of people at the next level down believe that the information is real. But when you ask them, can you show me the source data, the show me piece, you get to 0 or 1 out of 10. 10 out of 10, 5 out of 10, 0 out of 10. Follow the data and make sure that you've got that ability to weather the storm, because without it, you'll end up on the rocks for sure. Hope that was in some way aligned with the question, but
perfect. Thanks, Peter. Maybe just to go back to Mardi, in terms of the work in the IFRS, where do you think the priority is going to be in once the standards are developed? What are your next priority items? If you've got the sustainability reporting standards, you've already got the IASB standards. I know you're going to be working, and we saw in Veronica's presentation, there's this connectivity bit, and I know you're going to be working on the connectivity bit. But once you've got all of these standards, what is your priority as IFRS?
Thanks, Carolyn. Well, we're not going to have all these standards super quick, right? Because it takes quite a few years to pull these together under IFRS due process. So we're going to be busy for quite a while. So we're working, as you may have heard from Veronica, on the general requirements climate standard at the moment, and they're out for exposure until the end of July. And then we have to look at all the comments that we're already getting in and very detailed comments, and then rationalize those and hope that we can get it through the board by the end of this year. So that's just climate and the general requirements, which everything can hang off. We also need to internationalize and update the SASB standards for all of their sectors. And then we need to also consult later this year on the other areas where work needs to be done. So on the thematic piece, on the connectivity piece between the IASB and the IFRS, building off and using the IR framework as that really central cog in that. So there's a lot of work to be done, and I suspect that's going to take quite a few years. But alongside that, we have to support very much on the capacity building with regulators, with preparers, with investors right across the world to really educate about, but raise the bar an adoption of these standards and the adoption model, as I said, whether it be bottom up with the capacity building or top down with the regulators around the world. So we have a lot to do, but we also have to build a global model. We don't currently have offices, although we've signed a lease on them. We haven't built out the offices and the staffing of the office in Montreal and Frankfurt. In Asia, we still need to finish consolidating the Value Reporting Foundation later this month, the end of next month. Sorry, it feels coming very quick, 6 weeks away. We've got quite a lot of work to actually get a full board. We've only got 2 at the moment, right? So there's still a lot of work to be done, and it needs to happen fast. As we were talking about earlier, we can't drag this out over the time it's taken to drag out to write our sister board standards.
Wow, there's a lot on your plate. So you're not focusing on a specific sector right now, it's actually just getting that broad base in place?
So we have the broad base, so climate, so thematic, and sectors will run in parallel. So to be updating and internationalizing the SASB sectors, and they'll sort of run at the same time as we start to build out the thematic standards, but also work on the connectivity piece. So there'll be lots of technical people having a good think and work around, but on that, there'll be a lot of consultations and that will need your feedback on. And that's the most important part, is getting the feedback from you that are out there doing this in the market, so we can produce the best possible global baseline we can. We need the best brains on this. We can't, there's not another iteration of this, right? We have to get this right and quickly.
Thank you. Before we move to the summation that Mervyn's going to give us of the colloquium now, because we've just got 12 minutes left. But before we do that, just a last question to you, Mardi. Is there the theme of this colloquium is connectivity, connecting the financial and non-financial. Is there any sneak information you can give us? I know we all biting our nails in terms of how you're going to be using the integrated reporting framework. Is there any inside information you can sneak us?
Use the word insider.
I wish I could, but if you have, the integrated reporting framework was written just after CDSB's framework, and there are a lot of similarities in those frameworks and standards. And I can tell you, as we wrote the general requirements at CDSB for the ISSB, there are a lot of similarities. If you really read them, you already see a lot of the integrated reporting work in the general requirements. So, which will be the thing everything hangs off as the very starting point. So have a good look at that now, because you won't be disappointed. Sometimes you have to read a bit around, but it's there, okay? I promise. Because we did it. So I can tell you, my team did it. It's there. On the broader connectivity piece, we are still mapping that out. I believe there'll be a statement made in the coming weeks around the integrated reporting's integration into the foundation and what that will look like. So I can't disclose any more there. I haven't seen the last release, but there is going to be a public statement made about that and the future there. So, but having merged my standard in and seen how that's been integrated, I can assure you that the foundation really appreciates the legacy and the work that the community have put into building these frameworks and standards and the adoption of that. And anyone who's taken lead doing that, they're only going to be further ahead in terms of being able to use these new standards in the future. So please don't stop in the interim, please keep going. And I'm sure you won't be disappointed. Do have a good read. We've built off the best, right?
Thank you, Mardi. And that's a great place to end the colloquium. We've got Yasu, who's talking about what's happening in Konica Minolta, leading integrated reporting in Japan. Suresh talking about leading, being an award winner, integrated reporting in Sri Lanka. So thank you for saying to people, just carry on, because it's clearly, that work is going to be leveraged in connecting the financial and non-financial. But if I can, please then hand over to Professor King to sum up, if you can, all the discussions from today's colloquium. Thank you.
I could be over an hour, but I promise I will not be. Mardi used a word a moment ago of essential cog being the IO framework. And I believe that, because not because I was the founder chairman of the IOC, it's because I've seen it now in practice over the last 12 years, how it's essential to get that from the top agreement to do an integrated report, and then you get the integrated thinking running through, which Veronica spoke about today. The question I raise, which Mardi and her colleagues will have to consider, is the IFRS is an oversight body. So it's got no power to evolve the thing that it owns, the IR framework. And I think what has to happen, I speculate and I advise that the IFRS needs to just move that down to the joint ownership of the IASB and the ISSB, and then form a working group with the chairmen, chairpersons, vice chairpersons, and maybe one other member of the IASB and ISB as the working group, and then gets one of the trustees or some independent person to be the chair. And then the framework can evolve, because there'll be an involvement with all that's going on. But to leave it in the IFRS is almost powerless to evolve it. But I think if you pass that ownership, joint ownership down to the two siblings, I think so. If the mother body passes it down to the siblings, I think it's still in the family. So I start with a bit of advice and speculation. But so let me summarize today. Veronica, I've known for many years, and she was quite brilliant today in her presentation on connectivity. It was connectivity of functions, strategy, operations, you name it. And she showed how beneficial it is to have those things integrated and to develop. And the etymology of the word integrated is system, a system of working together. Connection, the etymology of connection is a link, you link them. And that was the debate that I had at Fortnum and Mason. And so we backed it. And I think the answer is, and probably will be, that you use both. So the IFRS sells down to the IASB and the ISSB, the integrated reporting and connection or connectivity framework, and you involve it. So you would make everybody happy. They've got the link and they've got the system. But what we tried to do, I joined myself with the IFRS. What the IFRS tried to do is to create the system of reporting, which will become the system of reporting globally. And I think it's more a system than it is a link. So I thought Veronica's presentation was thought-provoking and quite brilliant. The Alan Johnson, the president of IFAC, was just forthright in saying that IFAC, since the introduction of the thought of integrated thinking and doing an integrated report, has been supportive of it and believes that integrated reporting is essential for good reporting going forward and to make sure that a company operates and that it actually, from a business point of view, it improves. And so we called, or you called, Carolyn, two practitioners together. That was Suresh and Yasu. Yasu of that well-known company in Japan with 40,000 employees operating in 27 countries. What is it again? It's
Konica Minolta.
Minolta, that's right. Yeah. And how they introduced 5 years ago integrated reporting, and the board agreed. And I was actually having dinner with the chairman of the Tokyo Stock Exchange many years ago, and he said, you know, Professor, we're going to introduce this for our top companies. This is the right thing to do, and they did. And the benefit to some of the Japanese companies has just been enormous. And well, you heard Yasu today, and how to improve Minolta. Alan Johnson was also very kind of the things he said about me, that he thanked me for bringing these concepts to life and everybody be able to discuss them and to work on them. I think the GRI, unfortunately, we couldn't see, we could hear on and off the chief executive because of technical problems of the GRI. Now, I was the chair of the GRI, now chair emeritus. And I remember so well when I chaired the United Nations on governance as well, we looked at sustainability only from inside out. And it was, as I said, those seismic events of the collapse of Lehman Brothers and the GFC that actually taught us that there was also the outside-in impact on companies of the economy, society, and the environment. So when Lehman Brothers collapsed, we saw the change in the financial conditions of company, their balance sheets, their operating performance, which impacted on the income statement and the cash flows, impacted on the very risk profile of the company, which changed the cost of capital. So suddenly sustainability took on a new form. It was, we realized that like a lot of things, it's a coin and it had two sides to it. And so the building a global baseline needed this collaboration and alignment between the GRI and SASB, and also the discussions, or I think there's a Memorandum of Understanding or agreement, I'm not sure what it is, but the GRI and FRAG have become very close. And then I happen currently to chair PAFA, the Pan-African Federation of Accountants Advisory Board. And it's been fascinating to me, the different countries in Africa saying, you know, going forward, we think it's better for us as a developing economy to have sustainability reporting standards as double materiality, which is the European Union model. And you've seen in the last few weeks that the ISSB has added a parallel sustainability standards, which effectively are inside-out standards. So collaboration between the GRI and SASB, I think, is starting to work. But the GRI is, I think, very important, and its work is still continuing. I think the other thing that I think was very important in discussing with those two practitioners, Yasu and Suresh, that their integrated report they found was a great instrument for engagement with stakeholders. And there it is. And I think if you don't greenwash and you actually do a good integrated report, it's very interesting to me how many companies, and we've all been directors and chairman of companies, operating companies. And when you go and do a presentation to major shareholders, 45 minutes, 30 minutes, 45 minutes, and your integrated report, that's why you've said it must be short, concise, and understandable. And that concise nature, and when someone reads and really understands the user, then they can go into the detail, into the reports below, the financial statements according to FASB, let's say, and the sustainability report according to ISSB, or whatever that jurisdiction decides. The other thing we mustn't forget in the whole discussion today, IFRS has got an opportunity of becoming the predominant and hopefully the foundation for the global comprehensive corporate reporting system. But the IFRS was an institution started about 20 years ago as a private sector institution. They can't mandate things. So people have either got to accept it and then mandate in the country of choice. For example, let's take the US. I mean, it'll have to be mandated by the SEC. So we mustn't forget that. This is not going to become the Holy Grail overnight. End of summation.
Great.
Thank you very much, Prof. King. Thank you everyone for joining us. I think it was certainly a challenging colloquium from a technology perspective, but I think there's lots of very detailed and important information. And thank you for joining us. I appreciate it. We will be sending out the memorandum of the colloquium. As I said, it'll have some the detailed information where we've missed some of the, perhaps through technology issues, some of what was said. So that will be in the memorandum and you'll all get a copy of that, and it will be on the event page as well. So thank you everyone for joining us. Thank you for your kind comments. I'm just going to close tonight by just, re-showing that ESG Exchange video, and we hope to see you on, definitely on the 14th of July. July is when we're doing the joint event with Archer to discuss that ESG Exchange, the ESG value stack in a little bit more detail, to give you some insight into how to build your organization up towards sustainability reporting. So please diarize the 14th of July. It will be on our website shortly, and you will be able to get the link through our emailing as well. So thank you everyone for joining us. I will be putting the video on now. Thanks everyone. Cheers.
Bye.
Bye.
Thank you all.
Thanks, Gary.
Thanks
Caroline,
everyone.
thank
Yes?
you very much for your organization and hosting. Well done.
It's
Excellent.
a pleasure.
Really,
Thank
brilliant
you.
job. Really good.
Thank you very much, everyone.
Thank
Right,
you, Caroline.
Thank you.
Company reports will soon need to include both financial and non-financial sustainability information, but no one knows how to create sustainable reports that are both assurable and provide necessary information. In fact, no one knows what a good sustainability reporting system should look like. ESG Exchange's unique how-to playbook will change that. It will provide companies with a play-by-play guide to sustainability reporting. The ESG Exchange is a collaborative knowledge exchange. Its sustainability reporting development program is based on a 5-module playbook and is prepared for 5 key corporate roles: sustainable data collection and management capabilities, processes, analysis, reporting and assurance, and continual improvement capabilities. The playbook is created through global collaboration with leading standard setters and professional bodies. The ESG Exchange is an initiative of the Good Governance Academy with Mervyn as founder and patron. Its founding sponsor is Archer, a leading provider of enterprise risk management solutions. ESG Exchange represents diverse professions, economic sectors and regions. It is intended and positioned for corporate leaders and operational managers. The ESG Exchange is available globally with events hosted as online webinars, multimedia content, forums, learning management, and other online material are accessible via a secure online portal. All live events will be available in 3 time zones. The ESG Exchange will hold its first plenary in September 2022.
It's a vision I had in living in aeroplanes and going around the world to universities and business schools, lecturing, talking to international institutions like IFAC, people at IOSCO and IFRS, etc. That the teaching of business science issues, for example, ESG issues, were different at different institutions. And the understanding of it was different at different institutions. And the thought was to educate the educators to make sure that we had a bunch of new executives coming out that were really conscious corporate leaders. And the end game is to have a global comprehensive corporate reporting system. Caroline, are you still online? Carrie? Are you still online?